Hi, this is Wade Cook. I'd like to thank you for purchasing the Wall Street Video Seminar and congratulate you on a great decision. You know, I look back at my experience investing in the stock market, and I have about 9-10 years right now. I really wanted somebody back then who could show me how to do these things that I'm going to teach you here. Well, the Wall Street workshop and now this video presentation is designed to help you make a lot of money. And isn't that what it's all about? Is cash flow, building up monthly income? Well, that's what it's all about. And from the beginning of the sessions clear to the end, it's all about building up monthly income, helping you make more and helping you save more money. This first session is called Stock Market Dynamics, and it's going to take you into the water and get you started investing in the stock market and show you what kind of accounts to set up, what to do, and how to get making money right away. Well, let's get to the seminar right now. Good morning and welcome to the Wall Street Workshop. We're going to be discussing some cash flow strategies for the next 2 days. And, you know, I started teaching real estate seminars 15 years ago, and I was known back then as Wade Cash Flow Cook, and I don't want to change that at all. This whole 2 days is about building up your monthly income, building up assets that produce income for you. Now, if you came here to hear about mutual funds, you're in the wrong place. If you came here to hear about commodities, pork belly futures and all that, you're in the wrong place because we will not be talking about. Now, I'm scheduled to go to that First Lady's School of Commodities, but until I go to that school, I'm not going to be talking about those kinds of things. We're going to be talking about stocks, a little bit about bonds here at the very beginning, but mainly on stocks and how to cash flow your investments, to build up that group of assets that will produce the income that you need to live on. Now, I want to go over several points before we get into the Wall Street Workshop, and these are important because you need to understand what this seminar is and what it is not. Number one, obviously, those of you that are watching at home right now are seeing this, you know, you can tell that we're in a studio. This is not a hotel room. Usually when we have our seminar in a hotel room, we have a white overhead projector in the background. Obviously, we don't bring a taxi into every hotel room to do a seminar. And we have the overhead projector, not the TV monitors as you see around the room that we have here. So this is being shot in a studio, so that those of you that at home are watching this will be able to get high-definition graphics and be able to see on your TV screen the different things that we're talking about here in class. We had a choice in doing this video presentation in dating it and actually having a date so everybody knows exactly when this was filmed, or trying to use generic stocks, generic prices, and not being event specific. And we've chosen that we're going to do it, a real live seminar, and talk about real stocks. Now, anytime we talk about a stock price, I think even those of you here in the class will realize that we're talking about a snapshot in time. You can call up your stockbroker and say, what is the price of that stock? And he'll say $9. You call back 2 hours later and it's $10. Well, there are going to be people at home watching this video 2 and 3 and 4 years after we filmed it. Now, obviously, the stocks that we're talking about here in class and their current prices are going to be totally different than where they are, what we're talking about here today. But even though I've said that, we're still going to be event specific. So this tape is being filmed in the summer of 1995. Those of you that are watching at home will be able to realize that and know that if you want to date it, then you can go back to the prices of the stocks that we're talking about today. And if you're watching 2 and 3 years from right now, I encourage you to get your own stockbroker, check out your own prices, do your own homework. Right now, that brings up the next point. Because this is done in real time, in all of our Wall Street workshops, and those of you that are watching at home are going to have a chance of coming to a live, you're invited to come to a live Wall Street workshop as we do these around the country, mainly here in the Northwest. We want it to be really live. We want it to be actual. What we're going to do at an actual Wall Street workshop was to make money. It is not designed to be a seminar. It's not designed for me just to stand there and teach and to have no interaction not only with the audience but with our stockbrokers. Now, I have several different stockbrokers that we use for information, for charting services and all that, and we're going to get them on the phone. Matter of fact, about 10 minutes ago, I got off the phone with the stockbroker, and I said, now look, if you've got some hot deals, we're talking about several things that are happening right now. If you've got some good ones, don't feel bad about interrupting me, which they've done several times in class. So, and I'll ask the audience here, do you want to have this as a static seminar with old stocks that we've done before, or do you want to have real deals that are going on right now? What do you think? We want the real deal. So we want the stockbrokers calling us on the phone, and we'll call them several times, and we'll banter back and forth, we'll shop around, we'll look around, you know, and there may be a little bit of wasted time, but in real life there's wasted time, right? I mean, when you got him on the phone, you're sitting there waiting, he's putting you on hold, and this is real. That's what this whole Wall Street workshop is designed to be. So we don't have to work very hard at making it real. It just becomes real just by doing it, right? And all the things that can go wrong, go wrong. He puts us on hold and we get cut off and we have to call him back just like in real life. This is exactly what it's going to be here during the next 2 days. There's no way to perfectly script a two-day seminar like this, especially when you're trying to be live with real live players out there. All right, the next point is that we're going to do actual purchases here all the way through the Wall Street workshop. When I talk about the amount of shares, we're going to be dealing with 1,000 shares of stock. Now, if you can't afford to buy 1,000 shares of stock, then buy 100 or whatever you can afford. With most of the strategies that we're going to be teaching here, you're going to want to do them in 100 share increments. So you probably shouldn't buy 85 shares of one stock or 120. You should buy them in 100 share increments, and I'll explain that a little bit later. Now, the 1,000 shares, for example, if we're talking about a stock that's $2.50, that would be $2,500. But each time I mention an amount, and you as a class will just answer back, I say, okay, multiply this times $9, then your answer would be $9,000 because it's going to be $9 times 1,000. So all of our examples will be 1,000 share examples. All right. You've all been given an options booklet that says characteristics and risk of standardized options. Now, we are required to give you this booklet, and if you did not receive one in your pack, anybody watching this at home should call in and get this booklet. It is put out by the Chicago Board of Options Exchange at 400 South LaSalle Street in Chicago, Illinois, 60605. It's a great little book. A little bit technical in some places, but it's a good book, and you should definitely read this book to understand your risk and rewards of option investing. All right, the next point. I will not, in this class or in any of my seminars, make recommendations on any stocks that you should purchase. That is your own decision, and you take all the risk. You need to do your own homework on these things. For example, just because we mention a stock here in class, and just because that stock may be right for me, does not mean that it's necessarily right for you. It may not fit your investment parameters. It may be too much risk. You may not be able to do some of the strategies that we're going to be talking about here in class. Now, I'm going to bring this up right now, and I'll mention it several times throughout the 2 days. We're going to start off slow and go through some strategies that everyone can do, but within an hour or two today, we're going to be into strategies that some of you may not be able to do. For example, you may not be able to have margin accounts in certain margin type investing in certain of your accounts. You may not be able to do option investing. Maybe your stockbrokers think that with your level of expertise, which may be very small and very short at this point in time, you may not qualify for trading in options or something like that. You may not qualify for trading in certain types, and they have different levels at different stockbrokers, and they have a requirement test for you, and they'll make you sign off a piece of paper saying that you can or cannot trade in options. We're not going to be talking about really, really highfalutin strategies here at all, not in this class. We have a more advanced seminar for that. But in this class, we're going to be talking about pretty simple but really solid ways of building up cash flow into your account. Now, just remember, though, some of these strategies may not be right for you, so it's your obligation to find out for yourself if you can do them, if your stockbrokers will allow you to do them, and if you should be doing them in the first place. Because I don't know about you, but I have an incredible reverence for the stock market. It will lop off your head if you're not careful. It is very, very risky. A little bit more fun than going to Las Vegas in some regards because you can stay at home and do it, but it's almost as risky as Las Vegas. And if you're not careful, if you don't do your proper homework, if you don't find out more about companies and the quality of the information you have is going to determine the quality of your investment decisions, then you need to get better at getting better and more effective information. We'll talk a little bit about how to do that a little bit. Now, I hope also that this Wall Street workshop is the start, not the start of your investing, but the start of your educational process to get you to the point where you're very, very good at investing. Now, let me tell you what we're going to do here at the Wall Street workshop and then what we're not going to do. When I say this is a start, that means for you, it is time for you to learn how to do your own homework on certain companies. It's time for you to choose your own stockbroker and to find someone who really understands you and what you're after. It's time for you to make your own decisions, and most importantly, let me tell you what it's not. It's not time for me to keep any of your money. It's time for you to keep your money. Now, you understand that everybody that touches you after this seminar, when you walk out that door, any of you watching at home, turn off your video, and you go to start investing, everybody else that touches you is going to get something out of what you do. They're going to get commissions, they're going to get fees, they're going to get percentages, they're going to get a piece of the action. Everybody except me. I'm the only guy in your life that will get nothing out of what you do. Now, keep that in mind because then I can give you unbiased advice. I don't get anything out of what you do. But here's the point. This is designed to be a strategy session. And I must tell you right here at the very beginning, when I first started teaching seminars, I was teaching seminars in real estate. Basically, my style of real estate was to buy and sell and build up cash flow. You know, when we first started doing real estate seminars way back in the late 70s and the early 80s, every time we went into a state, there were all of these regulatory agencies out. What are you guys doing here talking about real estate? You're not licensed in our state. So, well, hold on, we're not selling real estate. We just got some books and tapes in the back of the room, and that's all that we're selling. Oh, okay. And virtually every state we went to, we'd have to prove to the regulation authorities that we were not there trying to sell real estate without a license. Well, likewise, by the way, with this new Wall Street workshop, we're running into the same kind of resistance around the country. Everywhere we go, states are saying, hey, you're not licensed to sell stocks. Well, we're not here selling stocks. As a matter of fact, we believe that we're in conjunction with the state regulation authorities. We're trying to show people strategies, methods, formulas to keep them out of trouble. Not only to get them making money, but to keep them from getting involved with unscrupulous people that are trying to sell some, units in a limited partnership on some jojoba farm in southern Arizona. Okay? Been there? Done that, right? And so, you see, my point is that we as investors are not very well armed with knowledge on all the different strategies and formulas that are available. So whether a stock is good or not is not the point here. We will use stocks for illustrative purposes only in this whole course. So if we talk about a stock, whether you should do it or not, that is up to you. And you have to make those decisions, and you need to probably do more research on any particular company than we're going to do here in class. But the point is that we're going to find stocks, and we're going to teach the formulas and the strategies on doing that. Now, all of you here in the class, do you all have a calculator? Okay, if you don't have your calculator, we've got them for sale in the back of the room at $10 a piece. Right? And you need to go get one at the next break or something, because you will need a calculator here. And by the way, these are calculators we bought for $3 at Walmart. We sell them for $10 here in class. Okay? No joke. Now, by the way, I tell you, we're going to run formulas here. I'm going to prove my point right now. Life comes down to formulas, does it not? I mean, if you got a race car, you have a certain mixture for the alcohol, the gas, and all that goes into the engine. It is the same thing. If you change that mixture, your engine does not run right. Now, in business, in my type of business, publishing and seminars, you have to be at least a 30% or less unit cost, product cost in your products, or you will go out of business. So if I buy a calculator at $6 or $7 and sell it for 10, the percentages are all wrong. I've got to buy a calculator at $3, sell it for 10, because it needs to be 30% of the sale price, or I'm out of business. It is that simple. And I've been in business now for 15 years, and by the way, I've seen a lot of my competitors come and go because they get their formulas out of whack. You stick with the formulas, you get a formula, and you work the formula. Now, I'm doing this as a way to prove a point. What we're going to be talking about here the next couple days is formula after formula after formula. And when we get to, by the way, when we get to the writing covered call formula, a lot of you are going to get tired of me doing this after 2 and 3 days. Now, I know a lot of you sitting here have come to learn about covered call writing. That's the main reason you're here. Good, because that is the main topic we're going to talk about. Over the next 2 days, we'll get in and out of covered calls and talk about probably 6 hours, maybe even 8 hours of the whole 2 days that we have together, because it's that important. And once you understand covered call writing, then you can understand all kinds of other option plays and other things about options, from buying calls to selling calls, buying puts, selling puts, and you'll really get into all those different angles once you understand the basic formula. Well, we'll go over that formula time and time again, and pretty soon you're in the class, I'm going to say, okay, run the numbers once again, and you're going to say, oh, do we have to do this again? Yes, you have to do it again until these things are in your brain, locked down, and you see over and over and over again how these formulas work. All right, well, let's get to it. Let's get to it. If you'll open your manuals to page 9. Oh, by the way, one more thing about the manuals, let me mention for those people that are watching at home. The manuals, you have 2 of those with a set that you receive. You're going to have a manual that is all just totally blank, totally not written in at all. And then you'll have another manual that is written in. So you'll have the exact verb. We got 2 people here in class. You'll have the words and all that we're covering here in class. So if you're watching this video and you just want to watch it and you don't want to particularly watch the, write in the manual, you may do so. Now, if you want to, though, write, let me tell you my style of learning. My style of education is this. First of all, I've been out here now as a public teacher, teaching publicly now for a decade and a half. I don't believe in the word teaching anymore. I've been out here too long to believe in teaching. I don't believe in it anymore. I used to. I used to believe that I could be a really great teacher. Everyone, I believe in education, but I don't believe in teaching. Let me tell you what I'm saying. There's an old Irish proverb that says, when the student is ready, the teacher appears. I could stand up here all day long and teach some of the greatest things ever, but when will they become real to you? When you need them, when you do them, when you implement them. You will learn these things. I can stand up and teach all day long, but you won't learn a thing until it becomes real to you and you need this information. So Those of you watching at home again, you have a manual that's filled out. Please do so. My idea is to get all of you involved with as many senses as you can. Your eyes, your ears, your mouth if you can. I'm involved with that all day long. Your writing, your touching, and get involved in this educational process. Now, I know a lot of you are saying, well, I don't take very good notes. So, by the way, those of you here taking notes, may I encourage you to not only take good notes, but also to write neatly. One of the most main comments I get is people get home and they say, I can't even read my own handwriting. You know, write neatly, go through this, because we will be taking a lot of notes. And I will remind you from time to time, you know, write this down. When I see you just listening, I'll say, write this down. Because well, it's really simple. The weakest ink is better than the best memory ever. So write things down and take good notes. All right, let's get to it. On page 9, if a corporation, if a company wants to raise money, it basically has two choices. One of its choices for raising money is that it can sell off part of its assets. Another choice for raising money is that it can go into debt. Now let's cover the debt first. If a company chooses to go into debt, one of the things that it can do is it can go to a bank and get a loan or some other kind of lending institution. Another choice for raising money, because banks control it so much, they control the interest rates, sometimes even took percentage of profits and all that, that companies got tired of kowtowing to banks, and they said, we're just going to go do a bond offering on our own, right? And they would float a bond offering, which was a way for a company to raise money and basically create debt against the company. Now, then it had two choices. If a company were going to raise money, it had two choices in a bond offering. One choice is that it could do the loan, the bond, with collateral, and the other choice would be non-collateral. So a company would just go out and raise money and say, we're going to raise money, and we're going to do this and this and this with the money, but we don't have any collateral for it. Hence, what is this called, by the way? Non-collateralized debt. What kind of bonds are these called? They're called junk bonds. There's no collateral backing it up. Now, in order to do so, then these companies would have to pay to entice investors like us. This company would have to pay a high interest rate, say 9 to 18% interest rate. Where on collateralized debt, it could pay between 6 and 9%. Now, think this one through. Could a company that does really, really well with raising money and does a great job with using that money to build up the company's assets have junk bond debt become non-junk bond? Yeah, because it builds up value in the company. And pretty soon, even though it was non-collateralized at first, it becomes collateralized in the future. Also, by the way, conversely, could a company that has really good, solid debt and collateral for the debt do a very, very bad job and have the company value go down so low that its bonds are no longer collateralized? And it could become junk bond at that point in time. So, and there's different ratings on these, and we're really not going to get into that type of thing right now because I want to spend most of the time over here. All right. If a company chooses to raise money by selling off its assets, it can literally sell off assets. I mean, it can sell off things that it owns. And the other way it can raise money is to sell off stock or shares in the company. Now, this is what we're going to spend most of the time on here at the Wall Street Workshop, is investing in stock in a company. All right. If you invest in stock in a company, we're going to, and as I go through these things, we're going to be talking about the jargon. And the next several pages in the manual and the next several minutes that we spend together are going to be on the jargon that you need to learn. I'm going to try to get most of you here talking like pros. When you call up your stockbrokers, when you say, I want to do this and I want to do this, and he says something to you, you don't feel like an idiot when you're talking to him, right? So one of the things you need to know is when you buy stock in a company, stock or shares, and we will refer to stock and shares pretty much synonymously, we'll say shareholders and stockholders, and to me it means the same thing. If you buy stock in a company and you actually own the stock, you are said to be in a long position. Long position. As a matter of fact, when you get your position statements, it will say long, long, long. It'll make a listing of all your stocks and it'll say long, 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 long. So when you actually own something, when you actually own a stock, you are in a long position. If you are in a short position, it simply means that you don't own the stock. You don't own it. Well, how does this work? How can you have something that you don't own show up on your position statement? For example, if you think that a stock is going to go down, you can actually sell a stock. You don't own it, but you've sold it. So you're in a short position because you don't own something. You can sell options that you don't own. So when you don't own, and a lot of you got to be saying, well, how do you do this? How do you sell something you don't own? Well, it happens all the time. It's very, very common in the stock market, and we'll discuss that over the next few days. But just so that you have the jargon down, it's long means you own something, short means that you do not own something. Now, we're going to talk about building up income. And in order to talk about this, I want to just kind of go back with you to the days when you got out of high school and you used to flip hamburgers. Remember those days? When you got your first job out of high school, $4 an hour, $5 an hour, whatever you got. We went to work and we traded our time for income. If we went to high school and then to college and we got a degree, we got a better job, and maybe instead of getting $4 an hour, we're getting $8, $10, $12, $15 an hour. Then we got a couple more degrees or whatever, we make $30, $40 an hour, but we're still trading our time for income. Got put on a $60,000 to a $90,000 a year salary. You're still trading your time for income. This income is called earned income. For tax purposes, it is called earned income, where you actually earn it. If you start up your own business, have a dry cleaning business or a pet store, you are still getting earned income. You're trading your time for money, and that is all earned income. And by the way, all that kind of income is subject to Social Security taxes. Now let's move over to the other, let's move on now. As you get a little bit older, hopefully as you start developing some assets and start building up a little bit of a net worth, at some point in time, you start investing your money. Maybe as a little rental house, and now you have rental income. Maybe you invest in some investment and you have dividends. Maybe you buy an investment and sell it and you have capital gains. Maybe you get involved in some oil wells in Pittsburgh, Pennsylvania, and you're in a royalty situation, and you get little $125 a month royalty checks from this oil well that you've invested in. The point is that is now unearned income. You have your money working for you, and your money is producing income, not you. Now, wouldn't it be nice, by the way, to get to the point that you have no more earned income and all you have is unearned income? What do you think? And that's where most of you are heading. You're heading from the point where you're trading your time for money to the point where you're getting your money to work for you, and the money, the money will earn money. Now, we're going to get to that point. If you really stick with these strategies here, you're going to get to that point very, very quickly, where you have a whole bunch of unearned income. Now, for tax purposes, unearned income and earned income are totally different, right? So we need to keep that in mind. So what we're heading for here, and almost everything we're going to talk about the next 2 days, is unearned income. Let's talk about a few of those right now. I see 3 areas of building up cash flow. Some obviously are better than others. 3 areas. One of them is corporate income. Now that means corporate debt in this example. All right, there are three things that we want to talk about with corporate debt. One of them is this. One of the ways of investing, and we're not going to spend a lot of time on this because I want to get down to number 3. Number 3 is where we're going to spend the next 2 days. But I want to quickly go through some of the angles that you may hear about, that you know that we're going to talk about. Some of these here in class from time to time. All right, with corporate debt, investing in corporations, you have a couple choices. One is just to buy a bond in the corporation. And you can choose the bonds, and by the way, you can choose, AAA rated bonds, you can choose AA rated bonds, you can choose BBB rated bonds. And by the way, once you get down in this level right here, you can get a really high rate of return as on the risk reward scale. This is where most of your money is going to be earned, right in this area right here. But you can just invest in corporate bonds. Another way of investing that is a combination way is to invest in convertible bonds, what we just call converts. And I want to spend a little bit of time on this one. In this type of bond investing, you have the best of both worlds. What a convertible bond is a bond that has a right sometime in the future, 5 years, 10 years in the future, to convert the bond into stock at so much per share. So you pay a price for the bond today, and then you can change the bond into stock at some point in time in the future. The good part about this is, number 1, you can get these with leverage, and number 2, you get income. See, these bonds, while you're waiting to convert them into stock, these bonds pay a certain percentage, 6, 7, 8, 9%. So while you're waiting to buy the stock in 3, 4, 5 years, you're getting income checks every quarter off the bonds. So you kind of get the best of both worlds. You get a little bit of income while you're waiting. And by the way, if the stock flies, for example, you could buy a bond at $8, and you have the right to convert it into stock at $12. Well, you're not going to convert the bond into stock if the price stays really low. But if this stock price flies to, say, $25 a share, and you have the right to convert it into that stock, that'd be a really good deal. You see the point? So you're locking in a potential higher price on a stock, at the same time getting income off the bond. That's what convertible bonds are. That's what they do, and they could be a very, very good play. I'm investing in several of those right now, and I really like them. Okay, the third thing I want to talk about in regards to bonds, corporate bonds, are what are called MIPS. This stands for Monthly Income Preferred Securities. Monthly Income Preferred Securities. When you came into the seminar, and those of you watching at home, you have in your kit an information kit. You have several different things in there, but one of the things that you have is a listing of companies that offer MIPS. Now, when I say preferred, this is actually preferred stock. Usually the rates of returns are somewhere around 8, 9, 10%. Here's the point. There are, at the time of this taping, about 180 companies in America that are so big, that are so solid, that are so profitable that they don't even pay quarterlies on a quarterly basis. Dividends on a quarterly basis or an annual basis. They pay dividends on a monthly basis. Now, remember a while ago we said that you're going to go from flipping hamburgers and that job to moving on to the point where you have all this unearned income? At some point in time, 8, 9, 10% a year may be just fine for you, but you want it in monthly income checks, do you not? You get those monthly checks. At some point in time, you're going to want to wind things down. And by the way, don't we live in a monthly income society, monthly check society, monthly billings? Everything comes on a monthly basis. So these companies have established these a special stock, a preferred stock, and they pay monthly dividend checks. And you have a listing of those in your information kit. And you can call any of your stockbrokers and say, could you get me a whole listing of MIPS? And by the way, the stocks go up and down a little bit, you know. And when they go down, you may want to buy them. And you could get rates of returns of 11 and 12% annualized really quite easily. And the stocks go up quite a bit, then the rate of return may go down, right, because it still pays the same dividend, and the rate of return may be 8 or 9 or 10%. But it's a good way of building up monthly income, and you may want to just keep that in mind. All right, now let's talk about government debt. Number 2, government debt. There are probably a lot of you that know a lot more about government debt than I do. I do know several things, and I do want to just cover a couple of those very briefly here. The one I do want to spend time on is letter C, 2C. But 2A, government bonds. Now, in government-type debt, you have 3 choices. One is you have bills, you have notes, and you have bonds. And the longer-term ones are the bonds. So when we refer to bonds, like a 30-year treasury or something like that, you know we're talking about government debt. These are backed, of course, by the full faith and credit of the United States government. And you can't get into an investment that is much safer. Because it is so safe, obviously the rates of returns are not very high. So you know, you're on your own on those. I don't invest in very many just bonds like that. I don't get into those. But let me tell you what I do, which is 2B. The type of government debt that I want to get involved in is government debt from municipalities. I mean, I live here in the Seattle area. I buy Bellevue bonds. I buy, you know, bonds. When I was in Phoenix, I bought Scottsdale bonds. I buy bonds in cities, and here's why. You see, a city, once it wants to raise money, it has 2 choices once again, just like a company. A city can go into debt. It can actually sell off assets, by the way, just like a company, or it can go into debt. To sell off assets would be like to sell off land, to sell off part of the city's holdings, right? And most cities don't want to do that. They usually try to acquire more land, not sell off existing land. And the other choice is that the city can go into debt. Once again, it could go to banks, or it could do a bond offering. Now, here's the problem. There's a problem with the city going into debt. You see, if a city goes into debt, the city fathers, whoever's, you know, the city council, whoever's raising the money, has got to ask the question, to whom do we owe our allegiance? Do we owe our allegiance to the people that are raising the money, from the people lending us the money, or do we owe our allegiance to the citizenry? Big decision, is it not? Big decision, because, see, who do they owe their allegiance to? Well, obviously to the citizenry. That's who they owe their first allegiance to. Well, then if they're agreeing to pay interest rates, like if the going market rate for interest rates is 8%, if they're agreeing to pay 6 to 8 to 9% interest rates, then the citizenry, the people there, are going to be saddled with this huge high debt. So they didn't want to do that. So basically the League of Cities, and the cities petitioned Congress back in the 20s and 30s when we had a heavy-duty income tax back then, 70 and 80% sometimes, and they said, would you allow us to raise money and have the people who loan us the money, you know, the bondholders, not have to pay income tax on the money? How would that be? So you invest in the debt, and now, by the way, now the city doesn't have to pay you 6 to 9%. Now it can pay you 4 to 6%. And the equivalent is the same as getting 6 to 9%, because if you got 6 to 9% and had to pay taxes, wouldn't it be the same as getting 4% and not having to pay taxes? Right? You see the point? And this is municipal, we refer to these as munis, municipal bonds, Some states and counties have these available too. And by the way, for those of you that live in a state that has income tax, more than likely your state also has a setup where if you, for example, we don't have an income tax here in Washington, but in the state of Arizona we had an income tax. If you would buy a Scottsdale city bond, right, an Arizona city bond, then not only did you get out of paying federal income tax on those bonds, you got out of paying state income tax. So there's a double whammy, right? So you get out of two kinds of taxes by buying a bond in that particular state. I know they have this in California. By the way, in New York City, they have also a city income tax. So in New York, the people that live there have a federal income tax, a state income tax, and a city income tax. So by the way, if you're a New York City resident and you buy a New York City bond, it's a triple whammy, because now you get out of paying federal income tax, state income tax, and city income tax on a New York City income tax for New York residents only. You see how that works? Whatever your income is, you don't have to claim it and pay income tax on it. All right, so now let me show you just a fun little calculation. A little box off to the side of your page there. Just a fun little calculation. How do you determine what your real rate of return is if you buy a municipal bond? So your stockbroker calls you and says, hey, we got a municipal bond. Those of you who got your calculators, get ready to go, because I'm going to need you to help me out here. All right, we have a municipal bond that's paying 5.65%. 5.65%, you know, as an interest rate. And then you got to say, well, is this a good deal or not? Well, what could my money be earning in the real marketplace? All right, the way you determine that is to take this is our first formula of the time. You take a formula and you to figure out, I'm going to come back to this 5.65 and we'll figure out what the real rate of return is. The formula is this. You take the interest rate that you're going to receive and you divide that by a constant of 1 minus your tax bracket. Now it's a simple little formula, and we'll actually do it. Let's put it right up here. Okay, so you take any interest rate. By the way, let's talk about this 1 minus your tax bracket. If your tax bracket is 28%, then you would take 1 minus 28%, right? And which would be what? 1 minus 0.28 would be 0.72, right? So in this case, let's go back to this now. In this case here, to figure out our rate of return, if we're in a 28% tax bracket, 5.65 divided by 0.72 equals what? Somebody do that for me. How much? So you have 7.85. Y'all see that? So a tax-free investment of 5.65 is equivalent to a 7.85 if you're in a 28% tax bracket. All right? Let's see how low the tax bracket, or how low it is if you're in a 15% tax bracket. So do it again. If you're in a 15, it'd be 5.65 divided by what? 0.85, which is 1 minus your tax bracket, right? And what's the answer here? What's 5.65 minus, or divided, what is it? You see the difference? So you almost have 1 percentage point difference by being in a 15% tax bracket. Is that kind of a fun little deal to know? So it's really simple. You just take the interest rate divided by 1 minus your tax bracket. It's not complicated. You can memorize this one very quickly. By the way, let's go to the maximum tax bracket at the time of this taping was 39.6. Let's try that one. Let's try that one. What is that? So you take 5.65 and divide by, what's 1 minus 39.6? 60.4. Is that right? It's actually point. Okay, so somebody divide this one for me. What is it? There you go, 9.36. So our rate of return now is 9.36 as compared to 7.85 in a 28% tax bracket. So it's just a fun little thing to know. And we're going, we don't need to belabor that point. Just get it in your notes. And so anytime your stockbroker calls you and says, I got this hot little municipal bond for you to buy, now you have a way of calculating what your real rate of return is if it's non-taxable. All right, the third point here, the letter C, is zero coupon bonds. Now I want to just give you a brief history on zero coupon bonds, because you need to know this. You need to know how good they are and yet a few of their limitations, where you use them, how to invest in them, what they can be used for. Now, throughout the next couple of days together, I'm going to make references quite often to real estate. You know, I cut my teeth on real estate. I made my first fortune in real estate. I retired first with real estate. And when I got involved in the stock market, I started applying a lot of the principles of real estate to the stock market. Well, obviously you can't apply all of them, right? Because you can't buy a dumpy little fixer-upper house in the stock market. But a lot of the same principles do apply. So I'm going to use real estate quite often to prove a point, and maybe a lot of you that have been involved in real estate, even with your own homes, can relate a little bit better to the stock market by going through a real estate channel to get there. I used zero coupon bonds, investing in real estate, as an incentive, as a kicker. right? Now keep that in mind because I'll come back and explain that in just a minute. But as an incentive, zero coupon bonds work really, really well. Here's what they are. You can get a bond, and if you get a, you'll see a nice thick paper, and it says U.S. Treasury bond on it. And it will say something like $20,000. So this one has a face value of $20,000. Now, in the old days, when they sold a bond like this, they would sell this bond for, say, $16,000. And over the period of time, the $16,000 would become worth $20,000, and in 25 or 30 years, you could cash it in and get the whole $20,000. In the meantime, across the bottom of the bond, they had these couple little rows like this of coupons. Now, these coupons were about as big as my fingernail right here, about as big as the tip of my finger. You literally take a razor blade and cut that little coupon off, a little thing like that. Or if you didn't do it every quarter or every 6 months, you could even cut off, say, this whole grouping of 5 of them right here, or 6 of them, whatever, and you could take all those in and trade those in at any point in time for the interest that was due on those bonds. What happened in the late 50s and the 60s is a lot of big brokerage houses in New York, and they call these cats and strips and a whole bunch of other names. They would buy the bonds, and they would take a pair of scissors and just cut off the whole thing. They just cut off all of the coupons. And the big brokerage houses would keep all the interest that was going to be due, every quarter, every 6 months, and then they would sell you just the bond part of it. And they got to keep all the interest. You see how they stripped off? Hence, these are called zero coupon bonds. So they got to keep the interest. But the good part was they sold them to you for like $2,000 bucks. So you didn't pay $16,000 for one of these. You paid like $2,000. Now, over the course of the time, they would keep all the interest, but you, at the end of the 30 years, would get the whole $20,000 for your $2,000. And by the way, I bought these, in the last few years, I bought these as low as 8 cents on the dollar, zero coupon bonds. All right, so let me tell you how they work and what they are and how you get involved in these. Zero coupon bonds they always start in 5,000 they always start at 5,000 shares, or $5,000 bonds. Then they go in $1,000 increments over 5,000. So if you call up your stockbroker and want to buy a $13,000 bond, you may do so. But if you call them and say, I want to buy a $3,000 zero, you may not do so. There's no $3,000 zeros out there. You can buy a $5,000, and you buy $6,000, $7,000, $8,000, and then any increments over that. You pay the $2,000. And by the way, how long does it take you to buy one of these bonds? Can you do this on the phone with your stockbroker? And stockbroker, now you can buy these from some of the federal agencies, but stockbrokers are probably your easiest source of finding these. And every stock brokerage firm has so many of these that they just have available. And you call up and say, so here's the first question I'll ask you. You call up and say, I want to buy a zero coupon United States Treasury bond. And they say, what date of maturity? And you say, way out there. Okay, seriously, just way out there. Now, it's 1995 right now, so the longest, they're always in 30 years. They start writing them in 30 years. But by the way, they haven't written them for the last couple of years. So if you call up your stockbrokers today, you cannot buy a 2025 zero coupon bond. They don't exist. The latest one you can buy right now is 2023, because they haven't written any the last couple of years, right? Now, pretty soon they're going to write a whole bunch of them again. Some of the brokerage houses get involved, and then there'll be some 30 years available at that point in time. Right now, about the maximum you can buy is 27, 28 years. But you tell your stockbroker, way out there, right? Way out there. Now, I'll try to give you some numbers. Please don't quote me on these numbers, but it works something like this. If you were to buy, depending on the bond market, if the yields are up or down, if you were to buy a $20,000 bond, and it's 30 years, let's do that one. If it's 30 years, you'll pay right now right around $3,000 for the bond, because they're a little bit high right now. If you were to buy a $20,000 bond and it's only 25 years to maturity, you'll pay about $5,000 for it. If you buy one that's 20 years to maturity, you'll pay about $8,000. If you buy one that's only 15 years, you'll pay about $12,000. If you buy one that's 10 years, you'll pay about $15,000. And if you buy one that's 5,000 or 5 years to maturity, you'll pay about $18,000 for it. You see how that works? The closer to the maturity date, obviously, the more you're going to pay for the bond, because it doesn't have that much time to go. So I like the ones that are way out there, so I'm paying small amounts of money. Let me tell you why. When I was involved in real estate transactions, and I must tell you that I never traded a bond for somebody's full equity in their house. Trading a bond for equity, something that's totally different, just never happened. I've heard that it's happened to other people, but it hasn't happened to me. But let me tell you what I was doing one time. One time I was trying to buy a second mortgage, a second deed of trust on a guy's house. We talked, I agreed, he called me up on the phone, and I agreed to pay. It was a little face value, just a little over $20,000. And I agreed to pay him $10,000 for that bond. About 3 days before the deal was going to close, he called me up on the phone and he said, Wade, I found somebody else that's going to give me $12,000. I'm going to cancel our deal. And I said, hold on, we got this thing in writing. You know, you got to sell me this thing for $10,000. That's what you agreed to. He goes, sue me. He's canceling the deal, right? Somebody else has offered him $12,000. He's just canceling the deal on me. And he thinks I'm not going to sue him for the $2,000, which he was right. And I said, look, you've changed your mind one time. Would you change your mind again? He goes, yeah, go ahead and make me an offer. I want to smack the guy. You know, I mean, this guy's wishy-washy as it can be. All right? And he said, what do you think? And I said, I'll give you the whole $20,000. He said, what? I said, I'll give you the whole, now you'll have to wait a while for part of it, but I'll give you the whole $20,000. Here's the point. Now remember, I was willing to give him cash of $10,000 before. I said, I'll give you $8,000 cash right now, $8,000 cash, and I'll give you a United States zero coupon treasury bond for the other $12,000. Now, it's not going to mature for many, many years from right now, but eventually you will get the whole $20,000. Do you see the point? You'll get the whole 20,000 bucks. It's going to take you a while to get this 12,000. You get $8,000 cash right now. By the way, that bond cost me $911 to buy the bond. He goes, you got a deal. Says, well, meet right now. Just get down there right now. Went down to the title insurance company, we typed up all the documents and did it all, and we finished it that day, and it was a done deal. By the way, did I make out better on this one? Because instead of paying $10,000, I paid the $8,000 plus, so I paid $8,911. I made that a little bit better. You see the point? Now, I'm trading debt for debt. Y'all see, I'm trading debt for debt. And it worked out very well. So let me say my sentence again. If you have these zero coupon bonds, to use them as a kicker, as an incentive. Another place I've used them quite often is people would say, well, I'd like take an option to buy a house for $5,000, right? But I don't want to put up $5,000 cash, I put up a $5,000 bond. Well, a $5,000 bond costs, what, $465 back then, you know, when I did this last one. $465. See the point? So $465, but they get a $5,000 bond for that. You see the point? So you're getting in with leverage and then trading debt for debt. And for that, it works very, very well. Okay, now, don't want to belabor the point with zero coupon bonds, but I do want to tell you the negative part about them. There's one little negative thing. They sound really good. Your equivalent rates of return right now are like 7.85%, 8% a year. So that's not a very good rate of return, but there is a place for them, which could be an incentive. For example, at my company, from time to time, we have sales programs with our sales associates there, and instead of giving them a $1,000, you know, bonus check if they get to some certain sales level, I may give them a $5,000 bond that costs me $685. Y'all see the point? So instead of spending $1,000, it costs me $685, but to them, they're getting a $5,000 check. You know, they're getting a $5,000 bond. Remember, as incentives, as kickers, these bonds work well. Let's talk about the negative part about them. The negative part of the bond is this. You have your bond that you just paid you bought a $20,000 bond, and let's say you paid $2,000. You wait it out and you shop, and you buy this bond for $2,000. The problem with bonds is simply this. It's a thing called phantom income. You haven't written that down. You may want to do so. Phantom income, because it is very negative, and you need to know about this, because you could get burned by this really quickly if you're not careful. Phantom income means this. The IRS basically says that these bonds are so liquid, right? Because you can call your stockbroker up and in just a matter of minutes sell these things. So the IRS makes you claim the profits each year, basically the interest they call it, each year, even if you haven't received it. You see, you bought the bond at $2,000. Instead of waiting 30 years when you finally cash the bond in for $20,000 and then in 20 or 30 years claiming that $18,000 of profit, they make you claim a little bit of that profit each year and every year, even though you didn't receive any money. And I'll show you the simple calculation of how to figure it. It's really quite simple, everyone. You take the profits. In this example, that'd be taking the $20,000 minus the $2,000, which is $18,000 profit. If this is a 30-year bond or whatever, then you just take and you divide the $18,000 by 30. What would it be in this example? 18,000 divided by 30 would be how much a year? $600. Y'all see the $600? So it's $600 that you have to claim each year. Now, if you're in a 15% tax bracket, you have to claim and pay taxes on $600 or $90. You see the point? Could that be really bad? Now, if you just have one of these little bonds like this, who cares, right? Go ahead and pay the 90 bucks, right, and you're okay. But what if you own several $100,000 of these bonds? And you had literally $10, $15, $20, $30, $40, $50,000 of phantom income a year. So you got all this income that you actually didn't receive the income, but you have to claim it and pay taxes on it as if you received it. Could that be a real detriment? Especially if you have a lot of these things. All right, so let me tell you where to use zero coupon bonds. and where you can best use them, and to avoid that phantom income. One place to use them would be in your IRA. They are a perfect investment for an IRA or any other type of pension plan, like a Keogh plan or a corporate pension plan. Zero coupon bonds are safe. They're just nice. Okay, and I'm going to tell you one other little angle to that in just a minute. Another place to use them would be for your kids or your grandkids. Now, you know, kids under the current tax law can have up to, $1,200 a year of earned and unearned income with no taxes due, right? So if you take our example here, you could own quite a few of these bonds, at $600 right here of income without them having to pay any taxes. So own them in the name of your kids. Now, it's not very exciting for your kids to get a Christmas present, open up and see the certificate sitting there, right? Or your grandkids and say, Grandma, they want a toy, and all of a sudden they get a little piece of paper that says, you have a $20,000 bond. But by the way, if you buy a little one-year-old baby a $20,000, $30,000, $40,000 bond for whatever price, are you basically helping them pay for their college? Because when they're 18, 19 years old, they could cash in the bond at that point in time and have college paid for. Now, those of you who have been to my seminars in the past know me. I am going to look for the silver lining in every cloud, am I not? Wade Cook is the eternal optimist on everything. So even though the negative thing about phantom income is that you have to claim it each year and pay taxes on it, what's the silver lining here? What's the good part about what I just said? Can you figure it out? There you go. At the lump sum at the end, when you finally get all the money, the $20,000, right, in 18, 20, 30 years, guess what? When you finally get the actual cash, guess what? You've already paid taxes on it. So you get this big chunk of money that you don't have to pay taxes on at that point in time. So yeah, that could be good. Okay, let me tell you one other quick little angle, then we'll move on. One other angle that I see a lot of people doing is this. If you're like 45 years old, you could buy, at the age of 45, in your IRA or in your company pension plan, a 20-year bond that expires when you're 65. Let's say that you determine at age of 65, and this is just taking some guesses on how much money you're going to need. Let's say that at the age of 65, you determine you want 60,000 bucks, just 60,000 bucks. Not income, just 60,000 bucks. So go out and spend $6,000, $7,000, $8,000, $9,000 right now. Buy a bond that matures when you're 65 years old. Do it in an IRA, right? So there's no income, no phantom income in the meantime. Your IRA basically cashes in the bond, and if you pull out a big chunk of money at that point in time, then you'll have to pay taxes on it at that point in time. Y'all see how that works? And then when you're 46, you buy a bond that's going to mature when you're 66. And when you're 47, you buy a bond that matures when you're 67. You see how that works? You just fund your retirement. So each year you buy one bond that will mature when you want it to mature. Okay? So that's a little angle that you can do in an IRA or a corporate pension plan or something like that. All right, let's move on. Number 3, and this is the crux of this whole 2 days because we're pretty much done with bonds and all that. Number 3, everyone, is to use the stock market like a business. To buy wholesale, sell retail. To learn cash flow strategies. I mean, the theme of most of my seminars for the last 15 years have been this. And all of my real estate seminars, all of my stock market seminars have been simply this. That you take cash, whatever little bit of cash you can scrape together, you put that cash into an asset, and you get it back to cash as fast as you can. Now, this is where I see people falling down, because there's a lot of people out there that don't treat it like a business, and they go to a seminar, they hear about a really great mutual fund, they hear about a really great stock or some other type of investment, they scrape together a little bit of cash, they plunk it down into a house, a duplex, a mutual fund, or a stock, and then what do most people do with it? They sit on it, and then they wonder why they're never getting rich. You've got to get back to cash for a while. You've got to stockpile wealth. You've got to take something and make something that was not there before. If you're doing this with sheetrock, if you're doing this with a pet store, if you're doing this with an ice cream parlor, you do so, you make something that was not there before. You build something into the economy. You basically prosper in the economy. Now, I've chosen, because of my busy schedule with seminars and with writing books, I've chosen the stock market as another format for getting involved in a business way, because I can do it on the phone. Does that make sense to anybody else here? Don't get me wrong, I love real estate. There are fortunes made in real estate, especially now in the mid-90s. With all the banks letting people take over loans like they are right now, it's phenomenal stuff going on. I mean, the stories I'm hearing right now are just unbelievable, right, what's going on in real estate again. But I'm so busy that I choose not to go out and fix up houses anymore. Is that okay, by the way? That's a part of my life. I've been there. I've done that. I don't want to go back there again, right? I've fixed up those houses. I've flashlighted basements and checked out spider webs. I've been there. I've done that too many years of my life. What I want to do now is to use the same principles there and make money in the stock market. And I found that you can buy wholesale, sell retail in the stock market just like anything else. By the way, a few months ago, Joan Rivers was on TV, and she said, God created Gentiles so we'd have somebody to buy retail. but it's good, isn't it? I mean, if you think about it, because we are so accustomed to paying retail for everything. I'm amazed at even how many real estate investors are still paying full retail for everything. If you're a real estate investor, can you not buy carpeting, paint, lumber, everything at wholesale prices? Yeah, you can, right? You can do everything at wholesale. We got to learn to buy wholesale, right? Same way in the stock market. We got to learn how to find bargains. We got to learn how to buy wholesale and then sell just sub-retail and turn it into a business. So that's what we're going to do here, is to turn everything into a little business and go cash to asset and back to cash. Now, one more quick point, and then we'll move on. When I say back to cash, I mean that you take a small amount of money here, you go into an asset, and then you go back to a large amount of money, or you go into income stream type money, where money just keeps coming in over a period of time. All right, and that's what we're going to try to create here. Is either income, big chunks of income, or perpetual monthly income. Now let me deal with that perpetual monthly income. By the way, how do you like the sound of that? Perpetual monthly income. Income that comes in irregardless of what you do. Now I learned that expression, by the way, when I used to sell life insurance. By the way, is that a good one for life insurance? You get a life insurance policy, somebody dies, you get a lump sum or an annuity type payment, right? So you can either take a lump sum or a little bit of money each month, right? And it will support you the rest of your life. Now I like that idea. By the way, that's when I started driving a cab, and I jumped in this cab right here because I was a life insurance salesman, and I started selling car insurance and all that. I was really good, by the way. In 1 month, I sold 23 house policies and 24 car policies. I made about $7,000 in commissions. But if any of you have ever sold insurance before, just writing up the policy and sending it to the company is one thing. Getting paid is another thing, is it not? Right? That's right. Waiting for commissions and waiting for policies to actually clear and waiting for this policy to cancel and waiting for somebody to get a check on because they're overweight, you know, all that kind of stuff. It was a phenomenal time. So I was very successful, but I had no money. Just to support my family, literally, to buy groceries, I had to go drive a taxi. I had to quickly run down and get my picture taken and went to drive a taxi, right? Now, a lot of you heard this story before, but let me tell it once again. When I got in the taxi that first day, by the way, my first day was car number 14. I had this little Dodge Dart that they gave me. Car number 14, that first time I drove, I got out with a guy named Bill Marsh in his taxi, and after 45 minutes, I said, please take me back to the company. I think I've got this figured out. He goes, no, you have to spend the whole day with me and, you know, to train. And I got back to the company. I said, Mr. Potter, my name is Wade Cook. I'm a brand new cab driver here. You don't know me, but will you let me take out a taxi? He said, no, you have to spend the day with Bill Marshall. You can't go out. I said, I know, I've heard that. And I was dressed fairly nicely that day. And she goes, okay, go ahead and take out the taxi. That day I went out and I made about $110. A couple days, the next day I made $90. The next day I made $140, and I was off and running. I was making $3,200 to $3,800 a month back then. This, by the way, is 1977, 78, right around there. I was making $3,800 a month. My lowest month was $3,200 because I went camping for a week. Well, after about 9 months, Mr. Potter died, and Mrs. Potter was going to take over the whole company, and she came in and talked to all the cab drivers, and they're all sitting there bragging about how much money they're making. And old Bill Marshall said, oh, 1 month I made $900. And all the cab drivers are going, ooh, how'd you make that much? And I'm going, whoa, what is going on here? I mean, my lowest month is $3,200, and these guys are making $900 and bragging about it? No way I was going to tell these guys how much I was making. I thought they'd hold me up or something, you know. And so I never told them. But by the way, I was living on about $1,200 a month back then, and I was able to take all that extra $2,000, pay my bills and take the extra $2,000 and fix up houses and buy little dumpy houses. And I bought 9 houses with taxi money that first year. But I didn't learn my lesson because, see, all the real estate seminars said what? Go buy a rental house, right? Go buy a duplex. Wait for inflation. Wait for Washington, D.C. tax write-offs. Wait for all these things that you're out of control. I said, man, after about a year of doing this, I said, this is just not making me enough money. This is not cutting it. So I decided if I was going to really make a lot of money, that I had to go back and do what I had done to the taxi. I sold a little house. After I sold that house and started getting all these checks coming in, I said, man, I think all these guys teaching these real estate seminars missed the boat. Why don't I just go out here and buy and sell houses for a while? And that's what I did. While they're all buying rental houses and holding on and fighting with renters and trying to collect rent checks, I was just buying a house, turning it, selling it, and carrying back paper and putting people into these houses, and I was able to retire at the age of 29. Now, I learned something, not only about houses, but I learned something that day driving a taxi. And let me tell you what it was. I watched Bill for 45 minutes, and I figured it out. Now, I'm going to tell you what it is, everyone. The absolute bottom line key to wealth, and you know what? Most rich people have already figured this thing out. If they haven't, as soon as I say it, they go, oh, I get it. You know, they've already done it, right? Most people have done this. The absolute bottom line key to making a lot of money, and I'll tell you this, and you know, and I've hobnobbed now with some of the most powerful financial people in this country. I've done over 1,600 radio and TV talk shows. I've met some of the greatest people, the greatest financial minds ever. And the number one key to making money is simply this. The money is in the meter drop. You get it? Most of you don't get it. You get it? Yeah. See, what happens as soon as you get into a taxi, what do? They put the meter down. Nowadays they have a little computer, they push a button, right? Bunch of wussies. We used to pull the meter down, right? What does that mean? How much does it cost to get into a taxi? $1.50, mine was $1.50, $1.80, right around that range. It changed. All right, now, the point is that a lot of the drivers would not take a run unless it was going to make them $30 and $40, right? They were sitting in Tacoma waiting for the SeaTac airport run, right? They always wanted the big $30, $35 run. And I was taking the $3 runs, the $6 runs. I'd run all over town. And the dispatchers know I'd run for all these little things. So I'd go to pick up somebody. I'd run to the house, scream there, get them out in the car, run where they're going to go. By the way, always pedal all the way down, just screaming across town, get them there, run around the capsule, get them out, rip the money out of the person, get on to the next deal, right? And all the other drivers are sitting around waiting for the big runs. And I'm taking 30, 40, 50 runs a day, and the other guys are getting like 8 runs a day or 9 runs a day. Who got more money just off the meter drops? You see the point? And by the way, do you think that those $3 and $5 runs turned into $15 and $16 runs when Aunt Susie wasn't home, and et cetera, et cetera, et cetera? You see the point? The money is in the meter drop. Well, I didn't learn my lesson because I'm just too hard-headed. I got involved in real estate. I listened to all the other pros, all the professionals in real estate that said, buy that house, then buy a duplex, then buy a fourplex. Remember that, all that stuff? Don't wait to buy real estate and wait. Well, I got caught up in all that stuff. I bought into that whole program, and it just wasn't cutting it fast enough. So I started selling the properties and turning them, and then I wrote the book, How to Build a Real Estate Money Machine. Just countless, tens of thousands of people now have retired and made a lot of money off that style of real estate, which puts the emphasis on selling, not on buying, and that's the key. Right? It's always easy to get into business. It's hard to get out of business. It's easy to get into real estate. It's hard to get out of real estate. It's easy to get into personal relationships with people. It's hard to get out of personal relationships with people, right? It's always easier to get into something than it is to get out of something, right? So it seems to me if you're going to make a lot of money, you got to get better at getting out than you are at getting in. Does that make sense? And now, even in stocks or mutual funds, should you not put the emphasis on getting out? Why are you for example, let me tell you a game that I used to play in real estate. You can apply this to the stock market. We used to have a game in real estate called Friday. That was the name of the game. It only had one rule, by the way. Guess what the rule was? Don't ever buy a house unless you can sell it by Friday. So we talked to a real estate agent. He'd say, oh, man, you really like this house. And I said, well, how much can we make by Friday? Oh, no, you'll love this one for your retirement. No, how much can I make by Friday? Oh, hey. This one's you'll love this one April 15th. You know, you'll love this one for tax. No, how much can I make by Friday? Now, when you ask the question, how much can I make by Friday, and if you don't like the answer, don't do the deal, right? Same in the stock market. Now, not all my stocks. We've got some, nice stocks that we just hold on to, like Disney's and Nordstrom's. My wife likes Nordstrom stuff. Boy, my wife likes Nordstrom's. But anyway, we have some stocks we just hold on to for our own portfolio. But other ones, we get in, we get out, and we make money within a week or 2 or 3. And that's what we use a stock for, is to buy wholesale, sell retail, to create cash flow. All right, so now, we're going to get into the nitty-gritty of how to do this, and it's got to start with something basic, something simple like setting up an account. So if you turn over your page to page 10, it is so simple, but we've got to cover it because a lot of people have never set up a brokerage account. Now, it takes an IQ about 3 points above that of a rock and no money to open up an account, right? It takes about 4 or 5 minutes on the phone. They will fax you an application or send it to you in the mail. You sign it. They'll even fill all of it in for you. You just sign it, send it back, and you have an account open. Don't make this hard. Now, the choice you have to make, though, is where you want to open up your account. And you have basically 3 choices. You can use a full-service broker, a discounted broker, or a deep discounted broker. And we need to talk about all 3 so you can understand what you're going to be faced with out there in the real world. All right. The first one is a full-service broker. And when I say that, I mean full service. I'm talking about they'll send you reports. They got analysts on staff that will do research reports on companies. They'll call you with deals. They'll do all kinds of things for you, right? They'll do research for you. They'll look up companies for you, send you all kinds of information about companies. And so these full service brokers do a lot more things for you than other people. Name some of them. I'll just put up the Merrill Lynch, Smith Barney, Dean Weber. Dean Weber, I mean. What's that? Well, no. We're going to put him down a little bit. Charles Schwab, we're going to put down the next one. Prudential. Okay. Prudential. And by the way, Prudential even has a discount brokerage part of it now. There's a lot. Piper Jaffray. There's a whole bunch of them. There's hundreds of firms that are what you call full-service brokerage firms, right? What happened was there was a man in San Francisco in the 60s that said, well, hold it. What about all these people out here that don't need all this report? They're willing to do the research themselves. They just want to place an order. They don't need all the help. Right? They don't need all that service you know. And this man started up a firm in San Francisco in the 60s. And what's his name?
Charles Schwab.
Charles Schwab. So then we have what we call a discounter brokers. And basically there's Charles Schwab, and I would throw Fidelity into that category. So there are basically two companies that fall into that category. Now, if you choose to fight the battle on price, I don't care what business you're in, are there always going to be a lot of competitors coming up to fight the battle? What do you think? So there'll be, around the turn of the century, a Macy's department store. Very high class, very upscale, right? And then right in 1910, 1920, along comes J.C. Penney's. Well, if J.C. Penney's is going to fight Macy's on price, is there going to be someone that's going to come up and fight J.C. Penney's? What do you think? Then there's going to be the Kmart's and the Walmart's and the Grants and all the others. Yes or no? There'll always be fights on price, if that's where you choose to fight your battles, right? So if the battle is being fought on price, then, oh, and by the way, let's talk about this. You got on the side of your page there, the commissions. Let's talk about a typical deal. Let's talk about a $2.50 stock times 1,000 shares. A full-service broker, the commissions on that $2,500 are going to be like right around 180 bucks or so. That'll be the commissions. If you do that same deal at a Charles Schwab type place, the commissions will be like $80. Now, if you go to the deep discounter brokers, and by the way, what are they? This is a group of guys, I mean, you could see like, I don't know, thousands of these. Open up Money Magazine, Wall Street Journal, you'll see their ads everywhere. They decided to fight, and they call themselves deep discounter brokers. And who are they? Name me some names. Quick and Riley, AccuTrade, National Discount Brokers, Jack White, Kennedy Cabot. I had an account there at Kennedy Cabot. I mean, there are deep discounter brokers. There's thousands of these, and they're all the way. You'll see ads for like 33 bucks a trade, $25 a trade, you know, $44 a trade, 3 cents a trade with a minimum of $25 and things like that. So a typical deal here would be like $40 for the commissions at a deep discounter broker on the same transaction. So what do you use? Where are you going to go now with this information? That's right. You go to the full-service broker. Now, I know it sounds weird, but I'm going to make a case for it. I'm going to make a case and kind of attack this question from a really funny angle. First of all, one of the things I teach in my seminars, I've asked this in my real estate seminars a lot. I have people raise their hand. I say, how many of you would like to make over $100,000 a year? And people raise their hands all over the island. Okay, now, if you want to make $100,000 a year, why are you talking to anybody about making money who's making under $100,000 a year? A lot of you heard me ask that question, right? Do you catch the point there, everyone? To whom are you listening? Where are you going for your advice? See the point? If you're going to make a lot of money, then you've got to start hanging on people that are making a lot of money. Let me say that the opposite. If you want to learn how to get rich, watch what poor people do and don't do it. Don't walk the way they walk. Don't talk the way they talk. Don't dress the way they dress. Don't do anything that poor people do, right? Now, the opposite is that if you want to get rich, what should you do then? Watch what rich people do and do that. Walk the way they walk, talk the way they talk, and shop the way they shop, right? And do business the way they do business. Let me give you an example. Now, I'm going to use this example for 2 points. One of the richest men in America is a man named Warren Buffett. How many of you ever heard the name Warren Buffett before? All right. What is he famous for? What's the company that he has? Well, he owns Coca-Cola stock, but through what company? Berkshire Hathaway. You guys want to have some fun? When you get your Wall Street journals out, we'll look up Berkshire Hathaway. It's a New York Stock Exchange stock. This man does not believe in stock splits. Everybody else splits their stocks, go up to 100 bucks, split it back down to 50, go up to 100, split it back down to 50. This guy's stock now, the time of this taping, right around $24,000 per share. Right, one share of stock in his company, Berkshire Hathaway, and it's been as high as $25,000 or $24,000 for one share of stock. Now, on any given day, depending on what his company is doing and his stock, wherever it is, he is the richest man in America. So on Monday, he's the richest man. On Tuesday, Bill Gates of Microsoft is the richest man. Then on Wednesday, Warren Buffett is. Now, Bill Gates passed him up this a little bit because Microsoft did a stock split. We're going to talk a lot about stock splits later. Microsoft did a stock split about a year ago, and the stock is already back up to where it was. Bill Gates has doubled his net worth in the last year. I mean, he's worth $5 billion. Now he's worth $10 billion, right? And Warren Buffett's still only worth $9 billion, right? So this guy's worth $9 billion. Now, my point is this. Where do you think Warren Buffett has his brokerage accounts? Where do you think General Motors has their brokerage accounts? At some cheap little discounted broker or at the big boys? What do you think? Then why should you have yours? If the richest man in America has his accounts at the big boys, then you should have your accounts there too. And I'll show you how to shop around and get preferential rates and get your commissions a little bit lower. My point is, do what the rich guys do. By the way, later on we're going to talk about covered calls. I told you there'll be a second point. Warren Buffett in the late 80s and the early 90s literally made hundreds of millions of dollars a year writing covered calls. Now, he did so on Coca-Cola. Coca-Cola, at that time, $46, $48, $47 a share, $49, $46, $48, bouncing all around there. Every now and then to get close to 50, he would write a covered call at 50, which is giving someone the right to buy the stock from him at $50 a share, but it stayed right around 48 or 49. By the way, he was buying them at 44 and 45, right? And by the way, if he had to sell it at 50, he gave someone the right to buy it from him at 50, would that be a nice deal? Be a nice profit, right? But he got to keep all those premiums. And we're going to talk about covered call premiums. He made hundreds of millions of dollars a year writing covered calls. Now, if Warren Buffett, the richest man in America, can make hundreds of millions of dollars a year writing covered calls, can I do so? Now, I cannot. I cannot start up a Microsoft. Are you all with me on that? I just cannot. I cannot do a Microsoft. I cannot become a Bill Gates. I don't know if I want to be a Bill Gates, but I cannot become a Bill Gates, right? But can I do what Warren Buffett does? Now, I don't have billions. Can I do it with $10,000? Can I do it with $5,000? You see the point? I can do the same strategies with $5,000 that he is using and doing with millions of dollars, right? So keep that in mind. Now, let's talk about a full-service broker. One of the reasons that I'm going to talk about a full-service broker is because, and I know that this is going to sound funny, but in most instances, I've really gotten tired of paying commissions. Now, I know that that looks weird compared to what you see on the screen, because what you're seeing on the screen is why would I pay 180 compared to 40 if I could pay 40 on the same stock transaction? And I'm telling you, everyone, I've taken all my accounts from the discounted brokerage firms and from my deep discounted brokerage firms, and I moved them all to a major full-service broker. I use Smith Barney. Right? Now, you choose, you use this information for what you will do with it, but, I like Smith Barney. Let me tell you why. First of all, I got a really good stockbroker there. All right? And in order to understand why I've moved on, we need to talk about a market maker, which is your page 11. And then we'll go back over, and I'll tie this back in to choosing a stockbroker. And then we get to page 12, we'll be talking about how to find, choose, and use a good stockbroker. All right, the word market maker. Now, if you're investing in OTC-type stocks, NASDAQ stocks, we are going to use the word market maker. If you're investing in New York Stock Exchange stocks, it is called a specialist, or the American Stock Exchange, it is called a specialist. Let me give you a definition of a market maker. A market maker is someone, well, I'll just put up the word here. It is someone who warehouses a stock. They actually do exactly what the words say. They make a market in the stock. They make a market. Now, let me give you an example. Let's say that a guy has a warehouse and he sells groceries to a lot of the little grocery stores around town. And he sells pineapple, cases of pineapple. Pineapple is being sold in the stores at 59 cents a can. There's a guy that comes out with a whole big article, a whole new diet that says if you'll eat pineapple 5 times a day, you will drop weight like crazy. I'm just making this up. Everyone at home, don't run out and buy pineapple. But boy, pineapple is a new crave. I mean, it is a new rave, and everybody around the country is going for pineapple, right? So they run in the stores, they're buying pineapple like crazy. Now, he was selling a case of pineapple at $22 a case. Now, all of a sudden, he gets all these phone calls from all these stores that want more pineapple. Well, he had 10,000 cases in his warehouse, but now he's only got 5,000. Now he's only got 3,000. What's he going to do? So he starts getting more phone calls, and he starts running out of pineapple. What's he going to do? He can raise the price. By the way, could he also order in more pineapple? So he calls Dole Pineapple in Hawaii, and Dole Pineapple says, sorry, you want 10,000 more cases? We can only ship you 1,000. We got to run on pineapple all over the country, right? And by the way, can Dole Pineapple then raise the price on theirs? So now instead of $22 a case, they're $32 a case for this guy to buy it, and therefore the retailers have to sell it at a higher price, all right? So you see the supply and demand here? The pineapple's right. So this guy's warehousing pineapple. He's going to sell it at a higher price, not just because he wants to get more money, but because he's running out of pineapple. By the way, a week later, the whole diet is proved to be a hoax. Big, huge negative article and lawsuits flying everywhere. Nobody wants pineapple anymore. Not even the people that were willing to eat it the week before, even though they didn't hear about the diet. So what happens to the value of pineapple? From the retail level down to the wholesaler, what happens? Everybody wants to get rid of their pineapple, right? No, the wholesaler can't sell it anymore. All right, now let's relate this back to the stock market. A company, the stock is, so let's go down. Let's talk about a bid and an ask. And let's continue to give you some words here so you can see how all this works. The bid and the ask. I'm going to continue to define words. The bid is, say, $2.50, and the ask is, say, 2 7/8. I want to deal with several things here, but I can't deal with very much of it until we start dealing with some of these halves and some of these 7/8 and all that. I've had a lot of people ask me if I would put a chart in the manual that would convert all the 1/8 into pennies. For example, 1/8 equals 12.5 cents. You know, right? And 2/8 equals whatever. So you divide 1 by 8 and you get 12.5 or 12.5 cents. So if you know 3/8 then would be 37.5 cents, right? 2/8 obviously is 1/4 or 25 cents, right? So, and by the way, 2 times 12.5 is 25. I've just, in my own life, I just have figured out how to deal with it, and I don't memorize these. I haven't memorized them at all. I've got a few of them memorized, but I'm just a cab driver, everyone. I'm just not that big, complicated guy that everybody thinks I am, right? So 1/8 is 12.5 cents. Okay, so by the way, then what is 7/8? Well, 7/8, that's almost 8/8. That's 12.5 cents less than $1, so that's 87.5 cents. So 7/8 is 87.5 cents, and 5/8, well, 5/8, that's 12.5 cents more than 50 cents, right? So that's what? 62.5 cents. All right, so 8s are 12.5 cent increments, right? So that's, so when you say, so the ones you need to memorize are 3/8, 5/8, and 7/8, right? Because you have 1/8, well, 1/8, all the odd ones, 1/8, 3/8, 5/8, and 7/8. Now, let's talk about the next one, 16ths. And we'll do 30 seconds in just a minute. Well, what is 1/16th? Well, 1/16th, you say, well, 1/16th, well, that's about 6 cents. Now, do you need to know exactly? Because your stockbroker says, well, here's a stock that is at 5 1/16. You say, well, 5 1/16. Well, 5 1/16, that's what? That's $5.06. Is that okay, by the way? Or do you have to say, well, that's $5.06.25? You see my point? You don't have to do all that, right? $5.06, just round it off, if you will, right? So a 16. So let's talk about what if a bid on a stock is 5 7/8, but the ask is 6 1/16. Well, that's $5.87, and the ask is $6.06. Y'all see how that works? So you got 12 cents, you got 6 cents. All right, well, let's go to one more. What about 30 seconds? Oh, by the way, stick back with 16ths for a minute. What would 1 7/16 be? No, not 32. 1 7/16. Well, that's 6 cents less than 50 cents, right? So that's 46 cents, or I'm sorry, 44 cents. You see the point? So you can round up to 44 cents. You see how that works? Okay, what would 1 9/16, and this is a very common one, by the way. The stock is at 5 9/16. It's $5.56. Do you see how it works? So 16ths or 6 cents. Okay, what about 30 seconds? They're 3 cents, right? Because if you take 3 times 32, that's 96 cents. So you're almost $1. So it's like 3.125 cents, right? But it's about 3 cents. So if a stock is at 3 3/30 seconds, what is that? What is 3 3/30 seconds? $3.09, right? You see the point? It's a little over $3.09. Is that okay? So that's how I deal with it. So if you can memorize them if you want to, or you can just kind of figure it out each time. And if I don't know, I just tell my stockbroker, well, what does that translate to in pennies? And he says, that is $9.97.25, you know, and then he'll calculate it for me on the phone. I don't need to know all this kind of stuff, right? There's certain kinds of information you need to know. There's certain kind of information you need to be able to find out. Well, this is one that you could find out, right? So in our example here, if we're doing 1,000 shares, the bid is $2,500 and the ask is $2,875. That's the bid and the ask. Now let's now talk about the bid and the ask. When you call up your stockbroker and you say, what is the price of the stock? And he says, 2 5/8. Now, by the way, look at my example up on the screen here. It says 2 5/8, right? And you say, well, what is that? Whenever he quotes you something like that, he is probably quoting you the last trade. Now, okay, so he's quoting you the last trade. So it last traded at 2 5/8, which is $2.62. But if you say, what is the bid and the ask? He'll say, it's 2.5 by 2 7/8, or it's 2.5 at 2 7/8, or one of the at or by in the middle there, which means the bid and the ask. All right, now, if you go to buy this stock, you're going to buy it at the ask. So when we buy stock, we buy at or somewhere close to the ask, and when we want to sell our stock, we sell it at the bid. So we buy at the ask, and we sell at the bid, or somewhere in between. All right? So in our example here, we have $2,500 and $2,875. Let's see how you could lose money here. If you went in and bought the stock, you know, just call up your stockbroker and say, I want to buy some of that stock. So he places the order, and you just pay $2,875 plus you pay like an $80 commission. Now, let's say the very next day you need the money. I shouldn't have bought it. I shouldn't have bought it yesterday. I need to sell it. What are you going to sell? And the bid and the ask hasn't changed. What are you going to sell it for? $2,500 plus another commission. You see the point? So you can't get rich buying at the, buying and selling at the bid and the ask. That's not what we're talking about here at all, right now. But what are we talking about? So you call up your stockbroker, all right? Let's talk about this word market maker once again, then we'll come back to this. A market maker in a stock is literally someone who makes a market in that stock or warehouses that stock. Now, there's a bid and an ask on a stock. If there's an order to place and there's an order to buy, those are matched up. The stockbroker, for example, doesn't want to have a whole bunch of stock that he can't sell. How does he make money? The market maker, not the stockbroker, the market maker. Because he is going to buy it at one price and sell it at another price. So let's stick with the 2 1/2, 2 7/8. Now, there's really, really good news on this company. Really profitable, making all kinds of money, doing a great job, right? And now everybody wants the stock. So the market maker, and by the way, every company has market makers. If they're NASDAQ companies, OTC companies, they have market makers. Now, one company may have 18 market makers. A company may have 1 or 2. An average company probably has around 10 market makers, right? They're all NASDAQ companies are all electronically tied together. All right, they all know what each other's doing. They all buy from each other. By the way, quick point. At the end of the day, when you say how many shares traded today, and it says 60,000 shares traded today, that's not a true number. By the way, you need to know this. If you're making a decision on a company and trying to decide how busy that company is, how active that stock is, when you buy a stock and they have to go to a market maker, but the market maker doesn't have the stock, where's he going to go get it? In order to sell it to you, where's he going to go get it? From another market maker who actually is warehousing the stock, who actually has the stock. Guess how they list that as 2 transactions. Even though it's only you buying the stock, but the market maker had to buy from another market maker, now that shows up as 2 shares traded for the day. Could you be a real problem here, everyone? If you're trying to base your decision on volume, whether the volume is really high or low on a company, right? Yeah. So what actually trades is somewhere between 40 and 60% of what you see in the paper, in the listing. Right? Just keep that in mind. Right around 50%. But somewhere between 40 and 60% of the volume is what the actual volume really is. Just keep that in mind. Now let's go back to this market maker. Everybody wants this stock. Everybody's calling saying, I want this stock, I want this stock. Everybody wants it. What do? What does he do? He doesn't have very much stock. He's only got like 10,000 shares. But somebody just bought 3,000 shares, somebody bought 2,000 shares. What does he do, everyone? He raises the price. So the what? The which price? The bid or the ask? He raises the ask, right, to what? $3, to $3.25, right? So now if you want to buy it, you're paying now $3.25, then $3.50. Now hold it. If he can get $3.50 for selling the stock, but he's still running out, people still want it, he hardly has any shares left. He got 1,000 shares left in his account. What does he have to do? Why? Why does he have to raise the bid? Because he's got to entice you and you and you to sell your stock, right? Because you won't sell it at 2 1/2 when you see it going up to $3.25 and 3 1/2. So he raises the bid to $2.75. Nobody's taking. $3. Nobody's taking. $3.25. As soon as he's at the $3.25, a lot of people are starting to sell him the stock at $3.25. Y'all see that? So he's getting. So now he has a. See, he's just a warehouser, right? He's got to have the stock to sell. So he buys the stock at $3.25. He's selling it at $3.50. Well, then it keeps going up. It keeps going up. Do you see the point? It keeps going up. Now, all right. Now, 3 days later, there's a lawsuit. What happens? Bam! Nobody wants the stock anymore, right? Everybody's trying to sell it. Get rid of this thing. I'll take $3.25. I'll take $3, right? Everybody's trying to get rid of it. What happens? Well, he's not going to pay very much for it, so he lowers the bid. The ask comes down. You see that? And by the way, watch my hands. The bid and the ask. Bid here, the ask here. Do you think that they go up just like this all the time, exactly even, or do you think they go like this? See, it's all based on supply and demand and what the market maker has. All right, it's all on supply and demand. So just to finish this up, we're going to move on, but just to finish this up. The bid and the ask movement, buying in the spread. Here's the point. The stockbroker calls up me, I'd say I want to buy 1,000 shares, and he says, okay, Wade, I got it for 2 5/8. Here's the point. If your stockbroker is a market maker, or will call the market maker and shop for you and make a deal for you, he can get it in the spread a lot. By the way, this happens probably 60, 70, 80% of the time I do business with a full-service broker. When I had my accounts with Charles Schwab and some of the other deep discount brokers, they just bought the stock right here, right? They just placed the order and got their commissions. But I have a stockbroker now who will go shopping. By the way, did I save any money? Look at the money, everyone. How much did I save? 2 5/8 is $2,625. And what if my commissions are 110 bucks instead of 80? Am I saving money? So here, in this example, I would have $2,955, and here I would have $2,735. Take your pick. See, I never got these kinds of deals when I was doing business with deep discounted brokers, right? I never got them. To get in the spread, you got to have somebody that's going to go shopping for you, and hopefully somebody that's a market maker, or their firm owns the market makers that are making a market in this stock, and then you can get the stock in the spread. I'll just tell you flat out, and we're going to wrap up this section. I'll tell you flat out, I have saved so much money by using full-service brokers. When I go back over the last several years and line up all my commission statements on my deep discounted brokers next to my full service, I'm almost paying no commissions on what they've saved me and getting better deals. You know, even though I'm paying a little bit higher commissions, what they've saved me on shopping for me and getting better deals more than makes up for the commissions that I'm paying. Plus, they call me with deals all the time. They actually help me make money with deals all the time. I'm going to explain that as we go through the next couple of days, because the whole idea here is finding a stockbroker that will go to work for you and help you make a lot of money. All right, when we come back, we're going to go to page 12 and start talking about choosing a good stockbroker. Okay, if you'll turn now to page 12, we're going to talk about choosing a good stockbroker. I've just got 6 ideas that I hope will help you find a good stockbroker. Now, please understand, I've gone through about 10 good, mediocre stockbrokers on the way to a couple that are very effective. And it's just like back in real estate. As soon as you get a guy trained, they learn your systems, they learn what you're doing, they make so much money, they usually go on to their own deals anyway, right? So my feeling is with the stockbrokers, you have this person in your life probably for 7 months, 8, 9 months, maybe a year or two, and that's it. They're come and go out of your life. So you kind of always be looking for new stockbrokers, because they'll get transferred, they'll leave, and don't think you're going to be able to bet your rest of your life on one good stockbroker. Now, I've worked hard at finding them, so let me give you several things that I look for. First of all, the number one thing that I like in a stockbroker is whether they like being a stockbroker. I know that sounds weird, but do they like it? Are they having fun? Do they enjoy getting out of bed? And by the way, do most of them have to get out of bed fairly early in the morning? You know, by the way, over in Hawaii, they have to get out of bed at 3:30 in the morning, right? The stock market opens over there at 3:30 and 4:30, right? So they can go and work until noon and go home and spend the rest of the day, but they got to get up early if the stock market's open. Do they like it? And by the way, let me just carry that one step further. Not only do they like it, but do they get it? Do they understand it? Now, let's talk about several things here. First of all, stockbrokers, just like any other business, get to be specialists. They may be a specialist in opening up IRA accounts and handling IRAs. One stockbroker may be a really good specialist in options, and somebody may be a specialist in mutual funds, right? I want to find someone that's a specialist in the same things that I like to do, right? Now, let's talk about real estate for a second again. When I was trying to choose a CPA, trying to choose a real estate agent to go to work for me, a real estate broker, I wanted to find somebody who was also doing the deals, okay? And by the way, that's another part of this whole thing, is are they doing it themselves, which will be number 2. Are they doing it themselves? Are they doing the deals? Now, you think this one through. I'm trying to relate numbers 1 and numbers 2 together right now. Do they like it, and do they do the deals, and do they get it? I'm not very good at playing basketball, but I love playing basketball. I'm not that good at it, but I at least know where to stand on the floor, right? I know where to be. If you've ever played basketball with somebody who doesn't know where to be, even though they may be very athletic in tennis or something else, if they don't understand basketball and where a forward, where a center, where a guard is supposed to be, then they're in the wrong places, right? They're always in the wrong places. So, you know, do they get it? Do the stockbrokers understand their role in this whole thing about bringing deals to the table and doing the research for you, helping you make better decisions, which is going to be, all the rest of these ideas are going to be based around helping you make money, helping you make better decisions. All right, let's talk about this. Are they doing the deals? I don't particularly want to do business with someone who's not investing themselves, you know. Now, a brand new stockbroker may not have any money, you know, to start doing his own deals. Let me ask you something, and I know that this is kind of a weird thing to bring up here, but have you ever gotten one of those phone calls from those guys that, like, they're in some stock brokerage firm back in New York, and they're calling, and they're trying to tell you about some hot new deal and some company that's going to go public and you can get on a ground floor opportunity? You ever had that kind of phone call? What do you do with them? Hang up? I guess I should, because I spend too much time with them. But see, I'm just too polite to hang up on the phone. So they say, Mr. Cook, we want to tell you about this hot new little company going to go public, and da-da-da-da-da-da-da, and you could da-da-da, and I'm hearing all this razzle-dazzle stuff. And I say, oh, sure, can I buy $10,000 worth of that stock? And you can literally hear the guy picking himself up off the floor. I mean, the chair has hit the floor, because I'm his, like, 85th phone call for the day, and I just told him I want to buy $10,000 worth of the stock, right? And I say, now let me tell you what I need. First of all, I need to see your personal tax returns for the last 3 years, and I need to see all of your own personal purchase orders for this stock. What do you need all that for? Well, I teach seminars all around the country, and I'm really big into this concept about to whom you're listening. Where are you going for advice, right? So if I'm going to listen to you, I want to know what kind of money you're making. Does that make sense, everyone? Now, I make really good money here. I make really good money per year, per day, per whatever. And if I'm going to follow your advice, I want to know what you're making. People come to me all the time and they say, well, Mr. Cook or Wade, can we give you some advice? I say, well, I don't know. Let's talk about that. How much money are you making with your advice? Now, I know that I make just under $1 million a year with my advice. How much are you making with your advice? You see the point, everyone? To whom are you listening? Where are you going for your advice? And you got to be very careful with this. And by the way, guess what the stockbroker does to me after I make all these requests? He hangs up the phone, and stop it. It goes the other way. The point is are they doing the deals, right? And by the way, do you think most of those guys that are trying to sell you a stock, you think that they're buying that stock themselves? What do you think, everyone? No. They're not doing it themselves, so why should you? You see the point? Now, by the way, when you call up your stockbroker, and you may have slept in that morning, you get up at 6:45, and you find out that your stockbroker has already bought 10 contracts on options on some particular stock. Is that a cool deal, everyone? If he's doing it, can you do it? See, that I like to follow. If they're doing it, then I may do it too. By the way, quick point. I use a lot of different stockbrokers. Almost every firm that I've been to, when you use that stockbroker, if you want to do the deal, like for example, if they call you up and they tell you what they just did, and you say, boy, I wish I could have got 10 of those, they have to back down and give you that position. Even if it's a little more expensive now, if they bought it 5 minutes ago, 10 minutes ago, or whatever, and they actually got in, they by their internal company contracts, they'll have to give their client priority position. Does that make sense, everyone? That's a good rule, is it not? Because then the stockbroker's not taking all the good deals, right? They have to be looking out for their clients first and give you the good deals, right? And then they may not get the deal because you took their position. And I said, God, I want you to get some too. No, well, if you want all 30 of them, Wade, you get them. It's a very good concept. So, but I like the fact that my stockbroker is doing the deals, making this kind of money. All right. The next thing is the computer. Now, I know that sounds cliche, but I want to talk about the quality of the computer that they have. These news retrieval systems and the quality of the computer. So number 3 is going to be a computer for several things, and number 4 is going to be the news systems that they have available to them. Now, let's talk about the computer, first of all. My stockbroker uses several different computers, and I know what's happening, because he's got one computer that he's typing up quotes, and I say, okay, here's a ticker symbol. By the way, I understand the word ticker symbol. Every stock is assigned that is NASDAQ, OTC, not pink sheets, by the way. All the pink sheets are just alphabetically listed, right? But once a stock goes on the computer bulletin board, or on NASDAQ, or on New York or America, or any of the exchanges, they are assigned a ticker symbol. And it's either called a trading symbol or a ticker symbol. Now, every time I say a stock here in class, if I know the ticker symbol, I will give it to you. So you can just write down the name of the company and also the ticker symbol. All right, so you give the stockbroker the name of a ticker symbol, like PBIO, Perceptive Biosystems, and BAM. He'll, a couple seconds later, give you a quote on what that stock is going for, the bid and the ask, right? So let's talk about the computer system, though. He has one for doing that, and he has another one, usually on that same screen or another screen, that has all kinds of news retrieval information, right? Another, maybe one more computer that is actually a tie to the floor, a trading computer, right? Usually the main computer that he has, he can place orders on it. Now, the reason I'm bringing all this up is because stockbrokers have available to them a lot of different systems that they can tie into. For example, let me cover all of these, and I'll go and put them back where they're supposed to be. Number 3 is having a good computer system. Number 4 is tying into these different news retrieval systems. Number 5 is having a line to the floor. A line to the floor will be number 5. And number 6 will be a way of keeping track and even calling you with deals. All right, that would be number 6. All right, so let's go back up and I'll fill in all the blanks here right now. The computer system. Obviously, you want good, fast information. If a company's going to go bankrupt, if a company's doing a merger or doing a stock split, that'll be number 5. There's all news retrieval systems. Most stockbrokers are tied to Standard & Poor's. If they're not, get out of there. Standard & Poor's, S&P, has some of the greatest different information systems available. They have a whole menu. I mean, the stockbroker can tie into S&P and have a whole menu of items available to him. All right, now let's talk about some of those. You need news on a company. You need different percents to double. You see, your stockbroker can have a percent to double screen, a 50% screen, other different information screens that you have available to get information. Sometimes that's called a delta screen. You see, we're going to talk about options later on. You need information. You need information for making decisions, and it's going to be based on the information he's feeding you. So you want the Standard & Poor's system. All right, let's talk about another news retrieval system. Probably the greatest news retrieval system available is a system called Bloomberg. Bloomberg. It's B-L-O-O-M-B-E-R-G. It's one word, Bloomberg. Now, they have their own TV shows and all that, and by the way, I'm telling you, everyone, this is worth a trip to your stockbroker's office. Call them and see if they have access to a Bloomberg computer, and go there and look at this thing. Go there and sit there for a half hour to an hour. Let them show you. Somebody that knows how to work Bloomberg, you know, and can really run the keyboard, they're phenomenal. This thing's got a speaker right there, the computer screen. You know how most computer screens, let's do up a computer screen like this. You have a computer screen, and you may have, you know, like a charting service like this, and you'll see the charts going like this. My goodness, on Bloomberg, it goes like this. You have available on the screen, and don't quote me on exactly like this, but boy, it's phenomenal. Up in the box up here, you have a 1-year chart. And over here, you can put up a 5-year chart on the same company. Down here, you have all the news about the company, the whole listing of that. You've got all kinds of other information here and information here. On one screen, they have a whole variety of things available to you. Let's say that the president of this company is giving a talk on CNBC, 10 o'clock today. Punch into your computer, and at 10 o'clock, bam, his voice comes right over the speaker. Oh, you're busy? You don't get until 2 o'clock, but you want to hear that interview? Go back and push a button, and it'll play. It'll retape the interview. 24 hours a day, news coming in from Asia, from Europe, all around the world. Bloomberg is the most phenomenal system you'll ever see, right? And by the way, they're very expensive. They're like $1,200 a month. So even in my stockbroker's office, we're like 60, 70 agents. There's one Bloomberg there, and they all share. One guy has it in his office. Whenever he goes to the bathroom, everybody runs in and uses it, you know. I mean, this is a phenomenal system, but it's very expensive each, you know, for a monthly fee to have that. And most stockbrokers can't afford it. It's $1,200 a month, you know, just for that one service. So Bloomberg is one of the greatest things that they can have. All right, let's talk about a line to the floor. That's kind of a weird expression, because it really is a line to the floor. I mean, a stockbroker could have a line and actually talk to the specialist on the New York Stock Exchange floor. Now, let's talk about how this works. You place an order. A stockbroker calls up. He calls up punches in the computer. Somebody actually prints up a ticket, runs it down to the floor, and you see those guys standing in the New York Stock Exchange and going, 444, who give me 4? You know, they're actually bidding for that, right? People are buying and selling the stock, and they're just doing that. You see that? Well, everyone, on NASDAQ, it does not happen like that. It all happens electronically. See, the bid and the ask, the different market makers, are all tied together by computer electronically. Literally, when you call up your stockbroker and you're trying to buy a NASDAQ stock, you'll say, okay, I want to buy 1,000 shares of that at $4.50. Okay, hold on. Hang on. Wait, okay, just a minute, wait. Oh, hold, okay, got it. It's confirmed. About 11 to 14 seconds, and the order is confirmed. It happens that fast. You know, you see these ads that say NASDAQ, the stock market for the next century, and all that. They're really true. Electronically, when European countries, Yugoslavia and Russia are setting up systems, do you think they're setting up like New York or like NASDAQ? What do you think? It's all like NASDAQ. It's all done electronically now, right? And that's more sophisticated than the New York Stock Exchange, and they're going to have to switch over some point in time because it is so good, you know, having this NASDAQ system. Now, the point I'm trying to make is that a stockbroker that will get on the phone, I mean, I've literally heard my stockbroker on the phone talking to me, and I know he's kind of not put me on hold, but he's just got me on one ear, and he's got the other phone on the other ear, and he's calling saying, okay, I got a client that wants to buy a bunch of those, and trying to get me the price. I know that you're at 4.5, can we get it at 4 3/8, right? And he goes looking for me, he goes shopping for me. By the way, can those deals make up for all the commissions that they charge? And by the way, sometimes when I get my little commission statements, my confirmation slips on a stock, I'll notice down in the commission box, no commission at all. Right? Because they're a market maker. So let me tell you what, another thing that could be on the screen here. One of the things on the screen at a stockbroker's office, on my stockbrokers, is a little M that comes up. M, the letter M, M-N-O, M, that comes up. And M, it just flashes, M. So when I call up my stockbroker, literally, a lot of the times, he says to me, we're a market maker in that stock. That's what the M means. They're a market maker. What does that tell you, everyone? If they're a market maker in a particular stock, what does that mean? They can probably get a deal for you. They can make their profits on the bid and the ask, not on the commissions, right? So a lot of times they'll get me in the bid and the ask, they'll make their profit there, and there's no commissions on the stock at all, except a little $4 SEC transaction fee. But that's all. I mean, I swear that happens all the time. I get in my commission statements, and there's nothing there for a commission. All right, let's talk about keeping track and calling you. Let me tell you about one other thing I like about keeping track. One of the statements, one of the computer software programs that your stockbroker can have, most of them don't have this, but I really like it when they do, and I don't even use a stockbroker unless they can tell me this, is my cost basis. It's a cost basis software program. Now, it costs them some money to have this, right? I just got notified by my stockbroker. The fee on this is about $500 per account. This is what a stockbroker has to pay per year, $500 per account to have available this information for you. But let me tell you what this information is. You bought some stock at $6, you bought some at $7.50, you bought some again at $7, you bought some at $7.75. You're thinking about selling it at $7.50 or $8 or $10 or whatever, and you say to your stockbroker, what is my cost basis in that stock? And he goes, it is $6.91. What does that tell you, everyone? I bought stock in that company 4 different times. And by the way, the $6.91 includes all commissions and fees that I've had to pay. That is actually my basis in that stock. Now, can I make a good decision on whether I want to sell it or not? By the way, would that tell you whether you should sell it at $6.50 or $7.50? What do you think? Because you're at $6.91. $6, that's your average. So you have an average cost basis in the stock, all those stocks that you buy. And by the way, does anybody else besides me like that kind of information? You need it. You've got to have it. By the way, most of your stockbrokers don't have this until I mention this. Now, you go ask them to get that for you, right? If they're making lots of money on your account, they should add on that service for you. And it really helps you make a good decision. All right, so I'm trying to talk, we're just talking about now choosing, using a good stockbroker. Now, the last thing I'm going to say here is this. A good stockbroker will call you and tell you about deals. All right, let me tell you one last week that happened. I really like stock split companies. Now, we're going to talk more about those as we go through this. I really like them. And I like not just buying the stock in stock split companies, I like buying options on stocks. And we'll talk about proxy investing in a few minutes. We made a whole bunch of money in the last few months on Gillette, on Pfizer Pharmaceutical, and I made a bunch of money on Intel. Now, you all heard of Intel, right? The big, computer, chip manufacturing company. I made a ton of money. I mean, I tripled, quadrupled, even quintupled some of my money in the last 5 weeks. Phenomenal stuff, right? On buying options on stock split companies. And I'm kind of getting out of some of my Intels. I'm going to show you the whole Intel deal in a little bit. I'm kind of getting out of some of those right now. Just for fun, last Thursday, this is a Monday, last Thursday I was talking to my stockbroker. I said, well, do you know of any other companies that are going to do any stock splits? And he goes, well, we really haven't had any announcement lately, but that TXN, that Texas Instruments, they're $140 a share right now. They're very profitable. Those guys got to be making some money here. So I said, well, what are the options on it? He says, well, and he checked them out, and they were, different prices, different, strike months and all that. They were $9, $11 and all that. And I said, well, let's get some of this, and let's get some of this. And I bought some options on Thursday before the market closed, right? Friday morning, he calls me and says, Wade, guess what? After hours, they announced a stock split. And by the way, the options were already up in one day. Now, we kind of got our vibes into this, right, about what's going on out there. I mean, looking for companies that are doing stock split. And by the way, the stock splits usually are accompanied by a large dividend payout on a company. I'll tell you more about this later. But the point is that he helped me do that. I didn't say Texas Instruments. He did. You see the point? And when I call up my deep discounter brokers and I say, what do you think about this? And are there any hot deals going down, right? Guess what they do? Total silence. They will not tell you a thing. Matter of fact, if you call them and say, well, I just bought a whole bunch of stock, $2,500, I just paid for this and made $5,000 in 3 days, they'll go. Then you say, are you guys allowed to comment at all? And they can say, yeah, we can say, way to go, or something like that. I mean, it's like they don't comment at all. There's nothing at all. And they will not even tell you whether you're doing a good job or not, let alone call you with deals that they know about. And by the way, what do you want? What do you want? You don't have time to go looking. There's 25,500 publicly traded companies in America. Anybody in this room got time to do research on all those? Check them all out, even all these different strategies. So what do you need? What do you need? Can a good real estate agent make a good real estate investor very wealthy? By the way, could one good real estate investor make a good real estate agent very wealthy? What do you think? It goes back and forth. Same way with the stockbroker. You want them doing their own deals, but you want them calling you with the deals that they're doing. All right. This next section on getting started will show you how to open up your brokerage accounts, make sure that you're trading right, because see, we want to get you started right so that as you learn how to make money in some of the more detailed sections that are coming up, that you're doing it right from the very beginning and you get your money working really hard for you. So let's get back to the seminar right now. Okay, we're now moving on to section 2, which is getting started, making all this stuff happen. All right. Nothing happens until you open up a brokerage account. Now, how many before you came here to class have a brokerage account opened up? Okay, most of you, how many do not have one? Okay, now do you understand? And you can't come to me during the breaks and say, Wade, I like that stock. Will you take my $5,000 and go invest it for me? No can do. You've got to have your brokerage account opened up, and nothing will happen until that happens. Now, let's talk about how much money you put in. You don't have to hardly put in any money at all. Let's talk about T+3. For many, many years in the stock market, if you buy a stock today, you have 5 days to get your money into the account. As of June 7th, 1995, that has now changed to 3 days. So you have 3 days to get money into the account. So here we are on Monday. If you call up your stockbroker and actually buy a stock today, you will not have to have money in your account until Thursday. Okay, so you don't even have to have money to open the account. You can get your accounts open right now. You don't need any money. You just get going. Just get your account open and get going. Now, how much are you going to put in there? That depends on what kind of account you have. Point number 2, when you open an account, make sure you open it as a margin account. Tell the broker that you want to have margin capabilities or margin trading capacity. Margin. Now let's talk about what margin is. Margin, everyone, is simply the ability to borrow money from your stockbroker. And we need to spend some time on this because this is an important part, and you need to really get this. And by the way, let's talk about important parts. I really believe that you're not going to get it, that you're not going to understand how the stock market works unless you understand that bid and ask movement, right? Buying at the ask, selling at the bid, trying to get in the spread, what causes it to go up and down, understanding what a market maker is, what he does, understand the whole warehouse concept. So once you understand that, then how do you play in that ball game? How do you play in that field? You take your mitt and your ball, and the way you do that is you open up a good brokerage account that will be effective for you. All right, that brokerage account that will do the best job for you is a margin account. Simply put, if you have $10,000 to invest at a typical stockbroker, even with no experience at all, they will allow you to buy about $20,000 worth of marginable stock. Now, I say marginable stock. Let me just say stock, and I'll come back and clarify that and define that in just a minute. You could buy $20,000 worth of stock with your $10,000. Now, how do you do this? How does this work? Well, in fact, the stockbroker is going to loan you the money. So in this example, you put up $10,000. With that much money in the account, he's going to loan you another $10,000, and you can buy $20,000 worth of stock. Now, what does a stockbroker get out of this? Well, he gets two things. One of the things a stockbroker gets is commissions. You get higher commissions on $20,000 than they're going to get on $10,000, and the other thing the stockbroker gets is interest. They're going to charge you an interest rate. You're going to be charged an interest on this, which can be anywhere from 7.5% to 9% down to 6.5%. It pretty much fluctuates based on the prime rate. Right now, today, it's around 8%. So if you have $10,000 out on margin, you've actually borrowed the whole $10,000 for a whole year, then it would cost you $800. Now, they're not going to ding your account at the end of the year. They're going to ding it a little bit each month. Right? So you'll, in this case, about $70 a month or so will be dinged out of your account, right, to pay for the margin interest. So they're loaning you the money. Now that they've loaned you the money, you got to think about this. Who is controlling the loan? They are. So they get to choose the securities. They get to choose the stocks that they're willing to use for collateral. So let me give you some rules of thumb on those kinds of stocks. And by the way, it's quite simple. In the day-to-day business, you just say, I want to buy that stock on margin. I want to buy it on margin. And they'll say, oh, that's not a marginable stock. So what makes a stock not marginable or marginable to them? All right. I'm going to tell several personal stories here. But what makes a stock marginable? They get to choose the collateral. Technically speaking, stocks under $5 are not marginable. All right? Stocks over $5 are. Now, that's not always the case. There's a lot of stocks under $5. For example, U.S. Air, you know, it's doing really well right now, but man, it got cleared down to $4 a share. It's a New York Stock Exchange company, a huge company, and just because that stock is down to $4 does not mean that it's not marginable, right? It's still on margin. One time I had a stock that was at $11 a share, a little company here in the Northwest called Midisoft. I had this account at Charles Schwab, and I got a call one day that said, Mr. Cook, you need to bring in $940. I said, why? They said, well, we had Midisoft on margin, but we're not going to allow that stock. You know, by the way, I bought it at $8, $9, and it went up to $9 and $10, and we're not going to let that stock be on margin anymore. Who's in control of this, everyone? Not you, the stockbroker. He can choose what he wants to have, what they want to put on margin. All right, now, I think to understand that, you got to understand what happens. And so we need to talk about another word called buying power. Now, again, I'm trying to get you guys up to speed so that when you talk to your stockbrokers, you're using the jargon that they use. If you call your stockbroker and you have purchased a whole $20,000 worth of stock, you could call them about a week later, 2 weeks later, and say, how much buying power do I have in my account? If you spent the whole $20,000, by the way, quick point, I don't think that you should spend the whole $20,000. And I'll explain why in just a minute. But you probably want to spend buy like $18,000 worth of stock and leave $2,000 kind of free and clear just to be in the account. You spend the whole $20,000, and you call the stockbroker, and you say, how much buying power do I have? And he'll say something like, hey, you have $800 of cash available, but you have buying power of $1,800. Well, hey, where did this come from? I mean, I spent the whole $20,000. Why do I have buying power of $1,800 after a month or so? Where did it come from, everyone? See, every night, midnight, or sometime in the middle of the night, the stockbroker's recalculating, recalibrating the whole account, and the stocks have gone up in value in this case, right? So you have more collateral in the account. Y'all see that? Because the stocks have grown in value. Therefore, there's more collateral in the account, which leaves you to buy more stock. There's more money there to buy more stock, right? So you call up another month later, and you say, how much buying power do I have? And they say $600. You haven't put in one more dime into the account, but you can now buy $600 more of stock. By the way, when he told me I had $900, I bought $900. I bought 100 shares at $9 each. Now he's telling me that I can have $600. I may buy another 100 shares at $6, some other kind of company. You see the point? So when I have buying power, that means I can actually spend the money and buy more stock on margin. Then you call up another month, and he says, you say, how much buying power do I have? And he says, no, you got to bring in $520. What's happened? What's happened? You have a margin call. What's happened, everyone? The stocks have gone down, right? The stocks have gone down, and there's no more collateral. So you either have to bring in cash or other securities to make up for the collateral. Do y'all see that? So it's a collateralized account, and the stockbroker gets to choose the collateral. See how that works? Now, you need to understand that we're buying power. How much margin capability do I have, or how much buying power do I have? And those are the exact words that you use. All right, so buying power. Now, stocks over $5, usually bigger stocks. Now, before I go on, I want to give you a definition of the word penny stock, because a lot of you are going to miss out on some tremendous opportunities by getting caught up in some misnomers, some bad information. So the word penny stock, so I want to differentiate between the word penny stock and the word low-cost stock. If you use a street definition of penny stock, it'll be something like this. A penny stock is any stock under $5. If you use that definition, it's wrong. And you're gonna lose out on some potential opportunities that you may not want to lose out on. Technically speaking, a penny stock is a stock that is not listed on an exchange, like New York, American, NASDAQ. So in this concept, a penny stock would be a simple pink-sheeted stock or a computer bulletin board stock, right? Which are some of the lower levels of stocks, smaller companies getting ready to go big, right? They start off on the pink sheets or on the bulletin board. Once a stock gets listed on NASDAQ or New York, then it's not called a penny stock anymore. Now follow that definition. Oh, I can think of a whole bunch of companies that have gotten down under $5. US Air I mentioned a while ago. If a stock that's a huge New York Stock Exchange company gets down to $3.50 or $4 a share, just because it's under $5, does that mean it's a penny stock? Now on the street definition, yes, but on the technical definition, yes or no? No, because it's still listed on an exchange. So the technical definition of a penny stock is one that is not listed on an exchange. Not the street definition is any stock under $5. So a stock like US Air, for example, that got down to $4, that is what I would call, what you should call a low-cost stock, not a penny stock. And there's a world of difference between low-cost or cheap bargain stocks as compared to penny stocks. So don't get caught up in these bad words when a stockbroker says, oh, that's a penny stock, you don't want to invest in it. You know, there may be some great penny stocks that you do want to invest in. There may be some great low-cost stocks that you don't want to invest in. Just because they're on the New York Stock Exchange does not make it a good deal. All right, so now with those definitions in mind, let's continue. Margin accounts. A lot of what we're going to talk about here today is on these margin accounts, and a lot of our formulas are going to be based on buying on margin. So as a simple example right now, if you buy stock at $5 a share, and you buy 1,000 shares of that stock, that obviously equals $5,000. Now, in our examples today, I'm going to continue to divide by 2. Divide the 5,000 by 2. Why? Because if you're buying $5,000, do you need to have $5,000 of cash to do so? No. If you're doing it on margin, how much would you need? $2,500 plus commission, right? So you'd have 25. So in this example here, you put up $2,500 plus a little bit, and you can buy $5,000 worth of stock. This is margin. And now a couple more quick points. As you grow and get more money into your accounts, or if you have money to put into your accounts right now, that 50%, everyone, is not a hard and fast rule. Remember, a stockbroker can choose how much he's willing to loan you and what he's willing to use as collateral. If you have hundreds of thousands of dollars in your account, can they even go down and say, you only have to put up $4,000 for every $10,000 you want to buy? What do you think, everyone? Right now, in my stock brokerage firm, I'm at 34%. So you just need to know, I've got a lot of money in my accounts. I'm at 34%. So in order for me to buy $10,000 worth of stock, I right now only need to put up $3,400. And I can buy $10,000 worth of stock. Now, when I first started, they were really held me firm on that 50-50, you know, that 50% thing. Okay? Joe?
Just because you do that, are they automatically going to sell it to you on margin, or do you have
No.
to sell them on every?
By the way, after a while, when your stockbroker knows, if you say to him, everything I buy, I want to buy on margin. So the question is, will they automatically put it on margin, you know, if you don't say so? At first, you need to say, I want to buy this on margin. I want to buy this on margin, right? And by the way, after a while, they'll just get to know that everything that is marginable, you want on margin. Does that make sense, everyone? And that's the way I am. So in my account, if it's a marginable stock, we buy it on margin.
If you have some cash in your account
Right.
in the money market, then what advantage is it to buy something on margin?
Because you can buy twice as much. The question is, what advantage is it to buy on margin? Yeah. What do y'all think? Yeah. What is the whole idea about buying on margin? If you got $10,000, what can you buy? $20,000 worth of stock. So if the stock's going up, you're doing the rolling stock, or if you're doing the covered call writing, you can do twice as many shares on margin. In my example, I can do almost 3 times as many shares on margin. So you don't want to pay the interest? Is that what you're saying?
Well, I'm just wondering, you're paying the interest at
8%, which is peanuts, right? But that's peanuts compared to the profit you're going to make on the stock, or the other strategies that we're going to show you. Yeah, it's just leverage into it. Yes.
When does the broker or brokerage firm get paid back? When you sell the stock?
When you sell the stock or whatever. When the deal is canceled, they just basically take back their money, right? So for example, if you bought, I'll show you a good example. If you bought on margin at 50%, if you bought a stock at $10, which would be at 1,000 shares would be $10,000, right? And then if this stock went up to $12,000 and you sold it, but you only put up $5,000 cash, right? When this deal is sold, you will have $7,000 in your account. Stockbroker doesn't share in the profits. He takes his interest, right? And you get your money back, your $5,000 plus your $2,000 profit.
If they don't buy on, you want to buy on margin, they don't. Can't they reverse that?
Just a minute. If you want to buy on margin, the stockbroker won't let you.
No, he made a mistake, and he actually, he didn't buy
That's happened before. His question is if you want to buy on margin, but the stockbroker places it. So you have different parts of your account, right? A type of this investment, a type of this investment. And if they invest in a non-margin account, and then you call up and say, hey, what's going on here? I thought I could, for example, they call you with a margin call. Or they call you and say, how much buying power do I have? And you think that you should have about $8,000 buying power, but you don't have any? You say, well, what's the deal here? They say, well, we paid cash for all that stock. No, I wanted to do that on margin. Then they can just undo it, right? They just put it on margin at that. It just takes 2 seconds on the computer, then it's on margin. It frees up your buying power in a matter of seconds, right? So you need to monitor your margin accounts all the time and make sure you don't get in trouble with them. Can you get in trouble with a margin account? It's pretty tough, by the way, because if the stock goes down, they're right there with a margin call, bring in $500 in stock or securities. And if you don't, they'll liquidate some of your stocks, right, to pay off the bill, right, to get the collateral back into the account. So it's really tough to really go too far wrong with the margin account, but you should keep on top of that and not rely on your broker. For example, even though I'm at 34%, and a lot of this stuff, I don't want to be at 30%, 34%. If there's a small downtick, if there's a bad month or so in the stock market, could I have a big margin call then? Because even a slight movement in the stock is going to make me have to bring in a lot of money to cover my position, right? So I still try to keep mine around 50%. Even though from time to time I go down to the 34%, I still try to keep all my stocks at 50% margin. All right, now, one last thing. You cannot buy on margin in an IRA. So if you put your $2,000 this year into an IRA account, you cannot buy $4,000 worth of stock. Okay, they just won't let you. Now that I've said that, I got to tell you that what I just told you is a half-truth. You can use your IRAs to buy on margin. Technically speaking, you can. But now watch this. If you put $2,000 into an IRA and then you buy $4,000 worth of stock, that part that you're buying with borrowed money, you personally will have to claim and pay taxes on the profits made on that half of your money, even though it's in an IRA. Could that be a bookkeeping nightmare? Think about keeping track of $2,000, and part of the profits are non-taxable, right, like in an IRA, and half the profits are taxable. It'd drive you nuts, so don't do it. So even though you can, don't do it. But now let's talk about pension plans. If you go to all of these guys out here that set up pension plans, if you go to Charles Schwab, Dean Witter, anybody that will actually set up a pension plan, most of them don't. If you bring in an existing trust document, they'll set up and they'll administer and help you run your stock accounts for your pension plans. They will not allow you to trade your pension plans on margin. Now, United Support Association, most of you know we have a company that sets up Nevada corporations for people, pension plans, living trusts, and all that. And those of you at home need to know that. We will talk about that in the entity structuring workshop. But for all of you, if you set up a pension plan through us, we have it approved by the IRS for the USA, United Support Association pension plans, to trade on margin. Now, is that important to anybody else here in the room? Yes or no? I got 4 of you nodding your heads. What do you think? Now think about this. You're getting ready for your retirement, and you've got your $10,000 you want to dump into your Keogh plan or to a corporate pension plan. And you put in your $10,000, and you can go buy $10,000 worth of stock. But if you set up a USA pension plan, you can now buy $20,000 worth of stock and really get that money going, right? If you're doing rolling stock or some of the other strategies here. So I think we're the only company in the country that I know of. And by the way, if you walk into Charles Schwab and you say, I want to set up a pension plan here, but I want to trade on margin, they'll say, you can't do that. Say, yes, I can. No, you can't. Oh, yes, I can. They'll say, prove it. So then you bring out your trust documents, right? And they'll look at it, and they'll say, where did you get this? And you'll say, I got it from a cab driver. We have it approved. And this is so state-of-the-art to allow your pension plans to trade on margin so that you can buy twice as much stock and get the stock going. Okay, one more point. Later on, we're going to talk about options. An option, everyone, is simply where you pay, instead of buying a stock at $20, you pay, say, $1 for the right to buy that stock at $25 in the future. You control the right. See that option right there? That $1? Now, they're always in 100-share increments, so this would be $100, and you would control 100 shares. Most of your accounts at first, especially, most of your stockbrokers, will not allow you to buy options on margin. You catch that? They'll allow you to buy stocks on margin, but they'll not allow you to buy options on margin. Now, however, I've been with my brokerage firm for quite a while, and almost all of my option plays I'm able to do on margin. Question for you. Is not this a form of leverage? Instead of actually paying cash for the stock, you pay for the right to buy the stock at this price or whatever in the future. Is that not a form of leverage? Controlling a little bit of stock, or a whole bunch of stock with a little bit of money? But now if you could come in with $50 instead of 100 and do the same thing, is that not a double form of leverage? So you're using leverage to leverage the stock, right? So as you get your accounts, a little bit more money in them, a little bit more experience, from time to time, ask your stockbrokers, can I trade on margin? Can I trade on margin? Can I do that on margin? Just keep asking, and pretty soon they'll get tired of you asking, they'll let you do it, right? If margin is important to you. All right, turning the page. Page 14. I am convinced, I am absolutely convinced that a lot of people do not know how to make money in the stock market because they don't know how to calculate a simple yield. They just do not know how to figure out a simple rate of return. So we're going to spend some time and do that here. We're going to talk about a simple rate of return. Now, let's talk about a complicated one, though, and then we're going to show you that we're not going to do that here in class. For example, in real estate. Let's say in real estate that you buy a house for $150,000, and you turn this little house into a rental property, and you only put $15,000 down. So your down payment is $15,000, and you have it as a rental. So this is a rental house. Now your rents coming in are $1,500 and your payments going out are $1,300 or something like that. Let's say that you net $125 a month. That's your net. Well, if you take that times 12 months, that'd be $1,500. What's your rate of return? Y'all see the 10%? Now this is an easy one because the numbers come out even, right? So you have $1,500 back and you spent $15,000. But hold it. Do you figure your rate of return, the $1,500, do you figure that on the $15,000 cash or on the whole $150,000? You figure on your cash, right? The actual cash that you have into this deal. But now hold it, though, hold it. Do you get the income on the $15,000 or the whole $150,000? The whole $150,000, right? This is a real estate deal now. What about the growth? So let's say that this property grows and it's worth $6,000 more at the end of the year. It's worth $156,000 at the end of the year. Could you figure that into your rate of return? Well, I guess you could, right? Because now instead of having just $1,500, you have $1,500 plus growth in the property of $6,000. Hold it. What about tax write-offs? So you take out, say, $30,000 for the land, right? You depreciate $120,000, right? You divide that $120,000 by 27.5 years, you get about $4,000 or $5,000 a year. So now you have $4,000 a year for tax write-offs. Is that a big savings there too? Could you not figure that into your rate of return? Because now you not only just have $1,500 net income, you have another $1,000 in tax savings. All right, you all see the point? So a rate of return can get very complicated, right? We could even take discounted future values to internal rates of returns. I'm not talking about any of that. For this seminar here today, we're going to talk about simply this, a cash-on-cash yield. Just a cash-on-cash rate of return. Before I do that, I want to show you another one. You go into a bank, you walk into a bank and you see a little sign there that's talking about CDs. There's a sign, and it says 6.06%. But then right below that, so this is the interest rate that it says, but right below that it says 6.52 effective yield. What the heck is this? What is a 6.06 and then it's all of a sudden 6.52? What is the difference here? So you have compounding, right? Either monthly or daily or sometime and wherever they post it and calculate it. So are you earning interest on interest in this example? So the effective yield is, by the way, is that what you really care about? Because at the end, if you have $10,000 in this thing, at the end of the year, you're not going to have $606, right? Or you see that? You're going to have $652. So that is the effective yield, and that's all that I care about here too, is what is the cash-on-cash yield that you have. So for example, if you buy stock for, say, $10,000, and you're able to make, say, $1,200 on this purchase, all right, now we need to figure out what and this is another easy one because you can just divide quite easily in your brain. This is 12%. But let's show you how to calculate this because they're not always going to be this simple. Let's show you how to calculate a rate of return, and here's the formula. And this is a simple formula. Any one of you can do this on any simple calculator. You just take the cash in, your profits, if you will, your gain, if you will, the cash that you're going to get back in, you take that and you divide that by your cash out. This is your rate of return. This is a simple deal. This is cash on cash. I don't care about tax write-offs here. I don't care about growth in the stock. I'm talking about I just made this amount of money. I put in $10,000 and I made, right. And in this example, in our other example, then we would take cash in, $1,200. We would divide by cash out of $10,000, and that would equal 0.12, or in fact 12%. Now, you have a 12% yield. Will you all agree with me that in this country, in our brains, we calculate everything on an annualized basis? So this 12%, if I just said you're going to get a 12% return on your money, what did you all think? All annual, right? Everything is calculated annual, is it not? Everything we do is annual. Now I got to unbrainwash you. We got to get rid of all this stuff because we're going to be talking about some 12 and 14% yields a month, and every 2 or 3 weeks, right? So when I say we're going to get a 12% return, you got to say how long? How long? Friday, or 2 Fridays, or something. So we got to get you to quit thinking about an annualized basis. Literally, we've been brainwashed too long. We've been led to believe that 12% is okay. And by the way, it constantly happens in these classes. We actually use an example. We get the stockbroker on the phone. We actually use an example right here in class, and it's a 12% 4-week return. And somebody says, well, I got 14% last year on my mutual fund. What's the difference, everyone? No, 14% on a mutual fund is a good deal, is it not? So 14% is a good deal on a mutual fund, and I said 12%, and they thought that the rate of return was better. Is it? No, because I'm talking about a 3 or 4 week rate of return. So if you have a 1 month rate of return of 12%, what's the annualized return? So you have to take it times 12, to figure the annualized return. Now I'm going to spoil a lot of you here the next couple of days because you're going to learn how to make 10, 12, 14, 15% on your money on certain deals, and we're going to teach you the formulas on how to do that. All right, so in order to move on here, we've got to just finish up on page 14. We want to treat our investments like a business. You buy wholesale, you sell retail. Just fill in the blanks there. Treat it like a business. And everything about this is buy wholesale, sell retail, buy low, sell high, and keep that in mind. Now, the last thing I want to show you is that little diagram that you see there on the bottom of page 14. This is going to help you make better decisions. There's a little bit of information here. And you're going to see that I put a lot of the emphasis on study and hard work. It involves with studying. Right? You have a diagram that looks like this. This is to help you make effective decisions. See, a lot of people will come up to me at my seminars, usually my real estate seminars, and they'll say, Mr. Cook, should I buy this duplex? Mr. Cook, is this fourplex a good investment for me? And I always say, I don't know. See, everyone, people say, is this a good investment? That's not the question to ask. The question to ask is, what else could you be doing with your time, and what else could you be doing with your money? Now, that's the right question to ask here, because can I make an assumption here that most of you sitting here in this room do not have an infinite amount of money? That most of you have a finite amount of money? Do you not? And if you only have $5,000 or $10,000 to get started, or $50,000 or $100,000, or even $500,000, do you not need to do the very, very best with that money that you can? And if you take your $5,000 and buy this stock, then what can't you do? If you spend all your money, what can't you do? Buy this other stock over here. So everything in life is a trade-off. If you do this, you can't do this, right? So you got to get your money moving and working the best that you can. So the lady says to me, is buying this duplex a good deal? And I say, well, I don't know. What else could you be doing with your time and money? She goes, well, I don't know. I just found the thing yesterday. It's going to take about $20,000 to put down on the property, about $15,000 to fix it up, and even when it's rented, it's going to lose $300 a month. Did she just answer her own question? But then the guy on the fourplex says, Mr. Cook, is investing in this fourplex a good deal? I said, I don't know. What else could you be doing with your time and money? He goes, I don't know. And I've been looking for 3 months. This is the best deal I've been able to find. It's hardly going to take anything down. It's only going to cost me $4,000 or $5,000 to get in and fix it up. And when I rent it, it's going to make $1,200 a month. What has he just done, everyone? You see, so when you ask the wrong question, you get the wrong answers. When you ask the right questions, hopefully you'll get the right answers. The right question is, what else could I be doing with my time and my money? All right, so let's go down to this effective decision making. At the top part, in the top part of this little diagram here, I want you to put in the word gather information. Gather info. So somebody tells you about a company, a stock in a company. Then it's time for you to start clicking into gear. Get information. What's the company doing? Why did it go up? Why did it go down? All about it. Start having people send you analyst reports on the company. Doing your homework on this company. At some point in time, you're going to stop. You're going to end the information gathering process, and then you move to the next process, which is to think and ponder about this investment. I'm just going to move on, then I'm going to come back and make comments on each one of these. At some point in time, you're going to quit this meditation process about the stock or the thinking and pondering, and you're going to make a decision. Then you change, and now you move on to the next phase, which is implementation. Now, implementation. Let's go back through all these. Let me make a comment here about this whole thing. If you are pretty bad at gathering information, you're going to be really bad at thinking about it, right? Because you got the improper information. And you're not going to be very good at implementing the strategy. Conversely, if you're really, really good at gathering information, then you're going to be able to think about it in a proper way, and you're going to be able to make the implementation a lot better. Your decision-making process will be a lot better. This, by the way, is where I think most of us fall down, is in that thinking and pondering stage. I'm convinced that most of us do not spend very much time thinking about our investments, thinking about anything, right? We just kind of rationally do a lot of things. Let me go back to my first few days as a real estate investor. When I was out buying houses at first, I was so excited. You know, when you buy a little house for, back when I first started, you could buy a house for like $55,000 and sell it for $70,000 by the end of the week. You know, some of these little dumpy fixer-upper houses. You know you're going to make $15,000 in a week selling a house. Is it pretty easy to get out of bed in the morning? What do you think? You can hardly wait to get up, right? So there at 4 or 4:30 in the morning, you know, I was awake. And I'd go over to the house. I was pretty tired. I'd get there about 5:30. And I'd sit down on the floor, because I was tired. And I'd lay back. And I literally laid back down on the floor in a vacant house. And I look at the ceiling, and I look at the door jambs, and I look around the house. Boy, you can sure tell a lot about a house by looking at it upside down, by the way. You should never buy a house unless you lay down on the floor, right? And look at it. Look at the, seriously. Now, I remember those days because I got to spend a lot of time with my houses. I could say, well, I want to paint this, I want to do this, I want to do this, you know. And I had a chance to think about each house. As we picked up that whole process, and we, instead of doing like one house every month or so, we started doing 2 houses a month, 6 houses a month, 4 houses a month, right? And I didn't get to spend very much time. Now, that little house that I made $15,000 on, never made those on some of these ones that we were processing very quickly. I'd only make $8,000, right? $9,000. But I was doing 6 a month. Is that okay? So I was getting volume, but I wasn't getting as much per house. Why? Because I wasn't spending the same amount of time with each deal. I missed those days, by the way. Even when I was very, very busy doing the real estate deals, I missed the time with each one of the little houses that I had. I missed that time. Well, it's the same way in the stock market. When I was first starting investing, I had this stock, and I knew everything about every company out there that I was investing in, like 6 of them or 3 of them. Now, I probably own stock in about 140, 150 different companies, and I can't hardly keep track anymore. That makes sense, by the way? You just get to the point where you can't do it. Now, I'm still making the money on volume, but I'm making a little bit less on volume than I was making back when I was spending more time dedicated to one particular company and studying it, getting in, getting out, getting in, getting out, doing the rolling stock, doing the range riders and all that. I'm making more money on a volume basis, but not more per share. I think that we need to be still. Let me just tell you my life, and I hope that this will be helpful to some of you at home and some of you listening here or watching here. I get very aggressive sometimes in my life, you know, like writing books and doing this batch of seminars or starting up something. And I found out, by the way, in looking back over my life, that those times when I was really, really aggressive were usually not the very best times in my life. Does that make sense to anybody here? Not only did I not make as much money as I thought, because it costs you more to make more, and et cetera, et cetera, et cetera. Sometimes when I just slowed down and let things happen, and I didn't hustle too much, you know, I just kind of let things happen, let things come to me. I was sitting in San Diego. Big, huge jetty out into the water, about 2 blocks out into the water. I walked clear out to the end of the jetty. And I was looking back at the beach, and I could see all the water coming in past me, and I could see the back of the waves flipping over into the water, you know, onto the beach. And I noticed there were pelicans there, and I kept thinking about the clams and the shells and all that down there. And the ocean, the tide brings them everything that they need, does it not? And I started thinking, wait, you need to be a little more like these pelicans sitting there. You know, the tide will bring them what they need. The tide will bring the shrimp and the crabs and everything and what they need. So I need to let things happen just a little bit more. Matter of fact, I don't want to turn this into Sunday school class, but there's an Old Testament scripture that says, be still. It's all said, be still. Right? And I think that we need to do a little bit more of that. When we gather up all this information, then we need to be still. We need to let our brains go to work, our conscious and our subconscious go to work to think whether we should be getting that stock or not. Usually when I've made my bad decisions, it's when I've been in a hurry. Right? Matter of fact, most accidents are caused when people are tired, when they're in a hurry, or when they're not in full control of their capabilities. Right? That's when accidents happen, the same way in the stock market. So we need to spend that time gathering up better information, thinking and pondering a little bit longer, and then our implementation will be much more effective. All right, now.